Good afternoon to everyone. Welcome to the 7 Galp Open Day sessions. We will start this third day with economic impacts and outlook on oil and gas sector debate. Before we get started, a few notes. At the end of this debate, there will be a Q&A session. You can make questions during the debate in the Q&A chat that you can find in the right side of your screen with the question mark icon. Also, to enlarge the streaming window, you should press the slides button. As moderator of this session, we will have Daniel Elias. Daniel Elias joined Galp Energia in 2004. Before, he held operational responsibilities in Transocean and Schlumberger. He has a degree in mechanical engineering from the University of Glasgow and Universidade Técnica de Lisboa, a Master on Business Administration from INSEAD, and energy postgraduate studies in Rio de Janeiro and Harvard universities. Currently, Daniel integrates the Society of Petroleum Engineers in Portugal as chairperson and is the head of development and production of Galp E&P business unit. Please welcome Daniel Elias, and the floor is yours.
Thank you very much, Diana. Thank you very much for the introduction. I would like to thank you all for joining us today. And especially, I would like to welcome Tom, Paul, and Ben to this session. I would like to introduce, it's a very interesting session and with a high quality panelist, so I'm looking forward to it. I would like to introduce first Tom. Tom Ellacot is the Senior Vice President of Corporate Research at WoodMac, which includes the corporate service, M&A service, and the corporate benchmarking tool. Tom joined WoodMac in 1996. He initially worked on as an upstream analyst, gaining exposure to the UK, Northwest Europe, and Southeast Asia regions. He switched to corporate analysis in 2002, leading the development and launch of the corporate offering. Tom has over 15 years experience of corporate research. He has covered over 40 of the companies in the corporate service, including majors, independent, and the main national oil companies. He currently leads the analysis on Exxon and Chevron. Tom has a postgraduate qualification in petroleum economics and management from the French Petroleum Institute and an MA in natural science from Cambridge University. Thank you a lot, Tom, for being with us.
Thank you, Daniel, and good afternoon, everyone.
I would like now to introduce Paul Markwell. Paul Markwell is the Vice President of Upstream Oil and Gas in ESSS Market Energy and Natural Resources Group. Paul joined ESSS Market in 2004 and has held leadership positions in upstream oil and gas research and consulting before taking his current role overseeing the upstream insight business in 2016. Prior to joining IHS Market, Paul had over 18 years experience in global upstream energy sector, spanning technical and executive roles with Shell, McKinsey, and independent oil and gas companies with postings in Europe, Thailand, and Pakistan. Paul holds a bachelor degree in physics from Imperial College London and an MBA from Henley Management College. In 2019, he completed an 8-year term as a member of the Council of Brunei University London, including 2 years as chair of its audit committee. Paul, welcome and thank you.
Yeah, thanks everyone. Look forward to speaking.
And I would like now also to introduce Ben Monaghan. Ben Monaghan is a partner in the Strategic Advisory Group at PJT Partners based in London. Ben focuses on clients in the oil and gas sector globally. He has 25 years of energy sector experience, including 20 years at JP Morgan, most recently as a leader of their consistently top-ranked Europe, Middle East, and Africa oil and gas investment banking team. Immediately prior to joining PJT Partners, Mr. Monaghan gained relevant experience in industry as a chief financial officer of a listed oil company. Ben has been involved in over 35 closed global M&A transactions in the natural resources sector with a combined value over $130 billion, as well as numerous investment grade and sub-investment grade debt issues and the raising of over 16 billion of equity capital. He serves as a governor of the Richard Reeves Foundation. Ben received an MA and BA in Russian and French from the University of Cambridge, UK. Ben, welcome to the team. I'm looking forward to it.
Thank you.
So the panel today, I took the liberty to initiate this panel with an HSE topic. And the basic message I would like to share is that disinfectant and PPE are basic, affordable products that we can all use to protect ourselves and the others around us. At the same time, I think it is important to reflect that these products come from the oil and gas industry, and they are affordable and sustainable, and today they are saving lives all around the world. At the same time, the oil and gas industry is keeping up in these unique times with this role of saving lives, also with medical equipment, highly advanced from a technological point of view, and sustaining the logistics that helps all the staff that are in the forefront of the current pandemic. So I would encourage you to use the PPE and at the same time understand the role that the oil and gas industry is playing. And last year I had an opening question, which was what took us to the meeting, and it was a physical meeting. This year I would like to ask you a question, which is for you to look around you, where you are. All of us are today in different locations, and I am very confident that everything that you touch that has technology associated with it, and everything that helps us connect, is a result of a strong contribution of the oil and gas industry. And I think this is a moment in our industry where we need to reflect on where we are, and at the same time how we can move forward to continue to sustain the quality of life of our fellow citizens the same way that we have been ensuring so far. So with these opening remarks, I would like to invite Tom for giving his angle on the current situation. Please, Tom, the panel, the floor is yours.
Absolutely. Okay. Thank you very much, Daniel, for the introduction there. And again, good afternoon, everyone. I think the first thing to say is that previous pandemics have changed the world, and COVID-19 isn't going to be any different. What it means for the oil and gas sector, though, is just a huge amount of uncertainty. Diana, I don't know if it's possible to pop the slide up. I've only got one slide, but it's quite a nice visual way of just showing the challenge facing the oil and gas sector. So what we're showing here are three energy scenarios that we've been working on. And our base case is for a recovery in economic growth from 2021. We basically assume a vaccine is in place from Q1. And that translates into GDP growth of 2.5% out to 2040. But COVID-19 does leave its scarring on the economic outlook. So we see a return to global economic growth, but from a lower base. Now, when we look at oil demand, jet fuel demand is suppressed for a number of years. Probably not a great surprise. We're all sort of quite reluctant to travel at the moment. But looking out over the longer term, there are two forces that are really driving transportation consumption. So firstly, when we get to 2040, we've got another 1.5 billion people on the planet. And secondly, you have a dramatic expansion of the middle class, and that's primarily in developing countries. And everyone's going to want mobility, whether that's in the form of an SUV or a two-wheeler. And of course, that has implications for oil demand. So let's zoom in on the scenarios. I'm going to focus on oil first. In greener growth, we're basically assuming there that economic stimulus packages are really designed to drive forwards an accelerated energy transition. But even under that scenario, it's only really when you get to the 2030s that you start to see a very steep falls in oil production. And that's really when we see electric vehicles starting to penetrate the market on a mass scale. So that's sort of what's impacting oil demand there. In GOIT alone, we assume an extended recession. COVID-19 is much harder to defeat, unfortunately, and the vaccine that we're looking for in Q1 is delayed. And that translates into slower GDP growth of about 2% per annum. And also, you've got shorter supply chains, which are impacting trade, impacting mobility, which is all eating into demand. But full recovery, as you can see, that assumes pretty robust growth in oil demand, and there really is no alternative to oil under that scenario this decade. And when you get out even into the 2030s, we've still got very strong oil demand. Turning to gas, as you can see from the right-hand chart, gas is more resilient under all three of these scenarios. What does this mean for oil and gas companies? Well, I think as the energy transition unfolds, portfolios are going to become more gassy. We've already seen that happening with the Euro majors, and I think it's a trend that will continue, no matter what the pace of the energy transition. So what does all of this mean for prices? I think that the main takeaway for me is that this crisis has really redefined resilience. Companies are now stress testing their portfolios under scenarios that were unimaginable, really, when at the turn of the year. But there is also a risk that we see a tighter market emerge. We've done quite a lot of analysis on the supply situation out to 2040 as well as demand. And what we're actually seeing is that supply is being hit harder than demand. So why is that? Well, you've got some huge reductions in investment, very capital disciplined investment programs in place. Growth projects have been pushed back. We've seen a big downgrade in tight oil production. And this is all impacting the supply part of the supply-demand equation. And when you look at the mass, you need $60 to $70 a barrel to develop new supply in the mid-2020s. And if you see demand continuing to grow in the 2030s, that break-even price continues to rise. So I think in summary, we've got huge uncertainty, huge risk, and there's also opportunities there as well. And this is translating into a huge amount of differentiation in corporate strategies. There are a few common themes. First of all, resilience. I'm sure everyone's heard a lot about resilience, but it is absolutely crucial to strategies going forward. Companies need to ensure that their portfolios are robust to very low oil price scenarios. And I think strategies need to be adaptable. Because of the range of uncertainty here. It is absolutely enormous, and we don't really know which strategy is going to play out. And all oil and gas companies need to be flexible, be able to adapt their strategy if there are big changes in the supply-demand fundamentals. So that's really a quick snapshot from me on some high-level thoughts on the macro environment.
Thank you very much, Tom. I really took note of the message specifically on supply being hit harder than demand, and also the different corporate strategies that we are adopting today. I'm sure we'll come back to it. Paul, would you like to share with us your initial thoughts, please?
Yes. This topic, we're being asked about the economic and the outlook for the oil industry. The question is, how predictable is it? Well, if you've been in the industry for a long time, you know that it is actually generally quite unpredictable, and having a black swan like COVID-19 come along is just another illustration. So the quick answer is, yep, it's really unpredictable. But I'd like to just spell that out a little bit. I think there are parts which are unpredictable. I'll talk a little bit about that. But also some things are predictable, and particularly how companies need to respond and to prosper going forward. So yeah, in the uncertainties going forward, of course, it's the economic uncertainties, the geopolitical uncertainties, the social factors which govern many things, but particularly the pace at which energy transition would come along. And of course, there are currently, of course, we're all focused on the recovery and the immediate issues. But I think if you're looking at for the oil and gas industry, you need to look very long term. So, Tom's charts there were out to, I think, 2040 or so. It doesn't take too long for other black swans to come along as well. So there are lots of other things that could happen after COVID. So we also paint the picture on different scenarios, as a way to differentiate different worlds, and those translate into combination narratives almost of how these different social, geopolitical, sort of technological, now sort of government actions to bail out industries, how those all come together. So demand and the acceptance of oil and gas as a fuel and so on, they all play out differently with a range of prices. So we could come back to that. I wanted to talk a bit about, so given all that, what is then predictable within all that? And I think there are a few things. One is, no matter what you believe or want to believe, if you're a player in the oil and gas sector, and I'm really coming at this from the upstream point of view, supply side, is you need to plan to be able to survive that lower price. So even if you believe, and we happen to believe that prices will recover in most scenarios within, 5 years, 10 years, and so on. But even if you believe that, that's not good enough. One has to be able to have a sustainable business at the sort of $40, let's say $40 a barrel range. How do you do that? That's one thing. So I'll come back to that. Second thing is shareholder sentiment. I think one thing that's different in this downturn compared to the one we had, it just seems yesterday, in 2015, is that there's much more scrutiny now from the shareholder base on companies to deliver returns. They've been through certain patterns in the US, in particular onshore, which has created a bit of a reaction in that regard, but it's general across the industry. And then also as the sort of concerns around ESG and the low carbon being more or less a license to operate. So, regardless of when you think or how fast you think the energy transition is coming, even if you know how to measure it, there is that need to be able to reflect that in company behaviors. So you've got the two things: survive lower price and adhere to or work with the shareholder sentiment that now applies. So it's really all about, to simplify, it's all about getting down the bottom of the cost of supply curve, being the lowest cost producer that you reasonably can within your capabilities, within your countries, within your chosen, if you like, resource classes. And, there are multiple ways to do that. The portfolios that companies have, we've seen a lot of moves towards concentration or specialization in recent years, the most obvious being North America onshore. In some ways, that focus and concentration is a good thing, because you do what you're best at, you reduce the cost by doing so, you create scale around that, and so on. But there's also vulnerability by being in too few types of assets that respond in a particular way when the price goes up or down. That can be a vulnerability. I think operating practices, driving down costs through technical engineering methods. We've seen a lot of moves in recent years around redesigning capital projects in ways that are more standardized, more phasing, more fit for purpose, if you like. That's all very good. If we sit where we are today, we think that there'll be much more of a shift towards operating costs, and not just thinking about operating costs per barrel and getting them down by pushing up the barrels. Industry's already done a lot of that. It's more about thinking what we're learning from COVID-19, all the different ways we now have to work within fields, and seeing how much of that we can actually, entrench into the business and make that the norm, to get operating costs down. And I think, right at the hub of this is really around the technologies that can be deployed, either existing technologies, digital or otherwise, that are already there and they're just not fully, rolled out yet, or new technologies which inevitably come along to help, across the board. We could talk about technology in more detail, but it seems to me that it's easy to say you need to be a cost leader, but you really have to break that down into, right, you need to be a cost leader on engineering, design, operations, portfolios, etc. So those are my thoughts, but bit of a kind of industry view there.
Yes, great. Thank you a lot for sharing those thoughts, Paul. I really retain your pragmatic approach of what is certain and what is uncertain and what can we really do about it, and specific the dimensions of ESGs, low costs, and shareholder activism. So this is really nice opening. I appreciate for that. And as a contribution, I would like also to get the views of Ben. I think you realize that we are having some technical difficulties, but I'm very optimistic on the Ben's contribution to this panel. Ben, if you'd like to share your thoughts.
Sure, thank you. The first thing when we talk about unpredictability in the oil industry is I think we should just recognize the supreme achievements of the industry over time, where despite what has been consistent volatility, the oil industry has managed to deliver long-term projects and make long-term investment decisions. I think that's one of probably the supreme achievements of the industry over the years. Now, wouldn't it be wonderful if, as a result of ESG, we now had a very clear path of demand, which meant that supply could match it efficiently, and then effectively volatility would be reduced. As Paul said, the lowest cost producer would fill the predictable demand. Now, sadly, as Tom probably showed in his opening slide, we're a very, very long way from being in a position where there's any form of consistent view of the future. If I think back to the last downturn, when, as you said in the introduction, I was sitting as a CFO watching my bond prices fall. I was trying to be optimistic about the outturn, but was feeling pretty helpless. This time around, I'm sitting helping smaller companies who are actually trying to restructure their balance sheets now. And then the bigger ones to really think about this new world that Tom touched on, where they have to evolve their strategies. But the common denominator in both of those sets of clients, as you might say, and the common denominator in the meetings, the board meetings, the creditor meetings I'm sitting in now, where banks are deciding how much to write off and whether they want to write off, where managements are trying to work out what to pay for an asset in this environment. And most importantly, a lot of directors of small companies, at least, are sitting around the board trying to forecast whether they will breach their debt covenants in the next 2 or 3 years. In all cases, the common denominator is trying to have some form of sensible forecast. But above it all, and actually Paul picked up on this point, the biggest thing that's different this time is that they're surrounded by a bunch of investors, debt and equity, who are really wondering whether the returns in oil justify the risk. They've been through cycles before, but the patience is certainly wearing thin. And we'll come back to that in terms of potential supply crunch. When we go back again to times when we thought we had stability of oil price, there is one very consistent theme, which is people believe it's stable. and they borrow against it. And Paul's word of, Tom's mention of resilience and redefining what resilience means. That's something companies conspicuously fail to do when oil seems to be at 90 and 100 and will stay there forever. Every downturn makes us admit that the new normal is an illusion. And you only have to look, at the press in the last week where you've got, just consistent numbers of US shale companies going bankrupt. You've got massive write-offs from the majors as they kind of redefine their view of the future, and restructuring teams everywhere, incredibly busy. Off the back of two sets of optimism. It was the companies who overinvested at too high a price, and of course it was the investors who gave them the money. So if we take as read the fact that there's been uncertainty and there will be uncertainty, how can people start forming a view to make decisions, given the black swans that are surrounding us? And I've sat in a lot of meetings where people say, well, the only thing we've got to rely on is the forward curve, because so many people trade it, it must be right. But I think we've all been around long enough to look back and agree that the forward curve, has never predicted anything. It's never predicted the oil price. So however many clever people trade it, it is pretty useless as a predictor of what will actually happen. Just as, and I think, Tom, you showed it on your chart, I think, if I remember, you had 2040 demand in a spread of whatever it was, 85 to 115 million barrels a day. That's a pretty big range to run a business around. And so, we've all seen those attention-grabbing, equity analyst headlines where, Bank X says oil's going to 10, and then 6 months later, oil's going to 200. The reality is everyone has the same imperfect information in something that is inherently unforecastable. The other thing that boards at the moment are trying to do is they kind of step back and say, well, is the world getting stronger? Our economy is recovering. And actually that gives you a real problem, because you say, well, what should I look at? Let me look at equity markets. And unfortunately, if you look at equity markets right now, they're effectively at an all-time absolute high. They're at all-time high valuation metrics, and they seem to be just shrugging off anything that's thrown at them. Unemployment, impending recession, COVID, second waves. You're getting small wobbles, but you're not getting a repricing. And they've sort of decoupled and are now focused on, stimulus, low interest rates, benign taxation, and just a wall of money. But then they don't provide a very helpful backdrop to really use to forecast demand. So then you step back and say, well, okay, what about oil? What about the fundamentals? And Tom laid out, various scenarios you can take. And I think, I'd agree that all the usual ingredients of uncertainty, geopolitics, break-even changes, technology, lumpiness of demand, they're all still there. And then we've added to it, what is the shape of recovery from COVID and this unprecedented drop of demand, and then also ESG. And, I know there are lots of discussions of ESG, how it's really come so quickly to be a big shareholder and company issue. But I agree with Paul that, this time it's different. And I think it's different because of the withdrawal of capital that it is forcing. And effectively, the public opinion that is pressuring investors is withdrawing capital quicker than individuals are reducing demand. It's kind of that simple, right? So you've got a wall of kind of capital messaging to boards and companies that is moving faster than the population is changing its demand signals. And so, from my much more simplistic view than Tom and Paul, that leads to a pretty clear risk of a substantially tighter market in the next few years. And then COVID's the other angle of that is, has the world really got the appetite to pay for ESG in the short term with all of the, short-term economic issues and unemployment that, could be coming, however attractive, the blue skies would be. So, step back from that, what can Galp and other companies do about it? As you come to plan your business and importantly, how do you allocate capital? Because that's the new defining, differentiating factor for any oil company because of ESG, because of continued uncertainty. And I think it's just a couple of things you need to both recognize and react to. I think first, the cost of capital is going up fast. No investor has made money in oil, and the outlook isn't any better. Investors hate this sort of unpredictability unless they're paid a lot for it. And the returns they've had have been just, in no way correlated to the volatility they've had to endure. So kind of that's number one, it's going up. And I think that gives oil companies two really clear challenges. Number one, they need to get significantly better at how they articulate capital allocation. They haven't had to in the past. It's been allocation between broadly similar businesses where no one said it matters if a project's 30 years long or 30 months long. That will change. This idea that you can put investor capital at risk for a large amount of terminal value after 15 years of cost oil in an offshore project, that is not acceptable to investors anymore. There's a penalty for duration risk, and the returns have to go up. And then secondly, and this is a much broader one, and I think Paul touched on it, is oil companies at the moment, Galp, Repsol, all of the European majors, to make that differentiation, are trying to run two equity stories and communicate two equity stories. Both the old equity story of low cost, high return oil, and a new equity story. And that's incredibly hard to do because it adds a layer of capital allocation challenge and communication of that challenge that is very difficult. So, maybe just to end with a straight answer to your straight question, I think, oil's as unpredictable as ever. On the other hand, that's what makes this industry so interesting.
Yes, Ben, thank you a lot for your contribution. And I think this panel also makes my job so interesting. I really value your inputs, and I think you made very clear the current dilemmas that we have as an industry, and also the challenges from a funding perspective that we need to address in order to meet the demand that the world is revealing to sustain. So I think it's a great contribution, much appreciated. And I think it's also a very good segue for the Tom early mention of different corporate strategies that he has been identifying in the current times. So Tom, I would like to ask if you could elaborate a little bit more and expand on these different strategies that you are witnessing.
Yeah, well, I think if we first of all start with the integrated, you've really got two extremes. So on the one hand, you have the Euro majors that are changing their business model more towards big energy. So they're treating the oil and gas legacy business increasingly as a cash engine to fund a strategic pivot into new energy. It's still fairly early days in what's going to be quite a long journey, but we are starting to see more meaningful investments now from the Euro majors and other companies, Galp as well, and Repsol. There are players like Equinor, for instance, where 20% of their capital will be allocated to zero carbon fuels in the early 2020s. So it's starting to get quite meaningful for these players. And that has implications for how they treat upstream, because, as I said, upstream's entering a harvest phase. It's really all about a margin business generating cash flow to fund that transition. Paul mentioned increasing concentration. I think you're going to see more of that, and that means more disposals, potentially opportunities for smaller players, private equity as well, to sweep up assets and expand their businesses in oil and gas. Then at the other end of the spectrum, you hear a lot about big oil. At the moment, I think we would firmly put the US majors in that bracket. It was interesting hearing Ben's thoughts around the market potentially getting very tight, and Exxon in its Q1 results indicated that as well COVID-19 could result in even stronger fundamentals for oil and gas because of the amount of supply that's been knocked out of the market. So they are still very focused on their legacy business, but there will need to be changes. And one of the challenges, I think, and touches upon the introductory remarks, is how do you square the circle? So even with big oil, the big oil business model, you need to ensure you're investing in the best projects. The economics need to be very, very strong if you're going to sanction a new development. There is a risk that we just don't see enough supply sanction in the near term, which will exacerbate the tightening of the market because screening criteria have been tightened up during the course of this year for obvious reasons.
Yes, I really value this perspective of the different players. But one thing in common is a potential tightening of supply, and I think this also to refer to the Ben observation, how to make an investment decision. And although the corporate world is approaching the current times with different strategies, they probably all face a common theme, which is the theme to make an investment decision in a capital-intensive business, with some segments of it with a long period for payback. So I really value your perspective on these different dimensions. And on the resilience side, Paul referred to good practices that we can adopt that are in a way predictable. And would you like to expand a little bit, Paul? The companies evolving on that dimension?
Sure. Well, I mean, we talked a bit there about, we talked in the introductory remarks, Tom talked a bit about the strategies and the portfolios, which I think is a really important part of it. But if you just get down more, maybe a bit more at the kind of investment level, the choices that you make for high grading projects and so on. As I said in the I think I said in the introduction, we actually see there is a bit more running room in reducing costs. It's been, in the last few years since the last downturn, probably the best progress we've seen on that. Well, on the one hand, best progress, I mean, a lot of progress in North America on conventionals, getting the unit costs down, but also in the engineering of projects, as I mentioned in the introduction. But we still see quite a bit of running room to get operating costs down. That's quite key. If you look at where the money is needed to be invested in oil and gas going forward, and again on the upstream, it's interesting. We think that the industry needs to spend around $4.5 trillion in the next 5 years. 4.5–5 trillion, depending on how you define upstream, which actually is about the same as in the last 5 years. Of that, over half of it is operating costs, and that all that money is going to be tough to fund for the reasons that we've said. So, if you can reduce operating costs at an absolute level, that is really key to unlocking the potential to invest more. I mean, what I'm saying is we've already seen the industry achieve a lot on capital cost reductions. It will continue to do that. But a focus on operating costs, doing things differently, we can see at least in our analysis, this is quite provocative sometimes because no one ever wants to believe this, but we can say, look, there's 20% more costs that can come out the system. And we're not talking about the supply chain, okay? Supply chain, by the way, Tom and I are both in the supply chain, so in a sense. But they've had a hard time, right? And there's probably a lot of consolidation required in the supply chain to take that forward. I'm really talking about the absolute operating practices, the way that maintenance is thought about, the flights and the logistics that are used to take crews to and from the facilities, and the application of what's already there, of course, predictive maintenance and automated technologies to help minimize intervention and things like that. These things sound a bit technical, a bit kind of stuff that's always been there, but really, with the whole onset of the digital revolution, really, there is still a way to go. And as I said, it takes a shock like COVID to make people think, okay, this has to be done differently. Why do we need that crew rotation? Why do we need so many people? Why can't we retrofit a setup so that there is less intervention on board and so on? So I think, at least on the operating cost side, that's just one piece, but I think that's an interesting one to think about. As I said as well, I mean, capital costs and engineering, those of us who, if you look back at what through the industry, the first offshore field was a breakthrough in technology, and every other field's a breakthrough, and it keeps going. I think in Brazil there's huge opportunities still to better understand reservoir delineation in certain cases, or to deal with contaminants, CO2 and so on. But we all know, if we're in the industry, there are opportunities. So that to me is a big leg of this story.
Yes, Paula, and I really appreciate your provocation, and I can assure you that as an industry player, they are taken on board. Meaning, we over the recent period we have taken several measures to reduce costs drastically. We have been observing for several months that we can actually operate with less personnel on critical activities. And I'm quite sure that with your challenge and the community challenge and even the situation that we have, we will continue to aim to do better. And I think it's a fair challenge. I would like to ask Ben, because Ben put some fair challenges on the table. I would like actually to feedback into Ben if he has any good examples on how to handle this dual equity story that we need to address in the current times, and or other dimensions that we can do as integrated oil companies or energy companies to look for funding in this challenging period.
Yeah, well, I think the issue in some ways was best summarized by the reaction of two separate investors publicly to Shell's dividend cut, which was obviously recent and surprised a lot of people because it came so soon into this downturn. It was kind of the opposite of resilience, right? Because it happened so quickly. And one of the investors, and these were two sort of big London major funds, one investor basically said, thank goodness you've cut the dividend. You can now afford to do new energies. I couldn't work out how the maths worked if you kept the dividend as it was. That's fantastic. Get on with it. Transition the business. Head into the future. That was one investor. The other investor came out equally strongly, and they said, your only purpose was to smooth my investment into oil. So you are now useless to me because you've just failed at the first hurdle, which is 3 months into a downturn, you've cut my income, and you've completely failed as an investment trust who told me you were a world-class investment case to smooth my investment. So, that's sort of the first indicator of the challenge oil has, is kind of what is its role? Is it big oil? Is it to continue to just pay the dividends from the legacy assets and be very cautious about how it invests in new ones? Or does it almost have a duty to the investors to go into these new areas where it may or may not have skills, but where there's a real shortage of investment opportunities? And the real issue is that those two stories are so fundamentally different, and there are two fundamentally different pools of capital. So at the moment, every year there is more and more ESG capital forming, and this recent downturn will have provided the most fantastic marketing material for the ESG funds, because any fund who was not invested in oil in the downturn will have massively outperformed the index. And so more and more capital will start following the ESG funds. The problem is there aren't many things for them to buy. So they end up buying the one or two quoted wind companies, who then end up with some very high valuations. So that's the story you're trying to head towards as big oil, is be seen as a low risk, low return, higher multiple, more predictable business. At the same time as you're trying to do that and attract that money, as I said earlier, the cost of capital for your legacy business, which is still the bulk, is just increasing. And the pool of investors is gradually reducing. And that is, for whatever the industry, that's a really, really hard tightrope to walk. And that's where we're seeing people struggle. And if you look 2 or 3 years ago at the statement CFOs in big oil were saying, they said, the wind returns don't match our oil returns. If you look at what they're saying now, their language has changed. It's, we think the risk-adjusted returns in wind are okay versus oil. There's a really important difference, which is they're starting to really price their capital in a more sophisticated way, and therefore accept that lower returns are fine, provided they've got a lower risk. But it's all about communication. And I suppose the irony of these equity stories, I was just thinking, I think it's this week, if I'm not wrong, that Tesla overtook Exxon's market cap. Exxon has, yes. And Exxon, I think, did 14 billion of earnings last year, and Tesla did -1, right? So yes. That kind of tells you which valuation you'd like to have, right? I'd like to have the infinite multiple on -1 rather than yes. a falling multiple on 14. So this is very live. But the other point I just pick up on is it always used to be about the rocks, right? And I think there was always a statement in the industry: if it's a good project, it'll get funded, because money will just follow a decent project. I suspect that's changed a bit. I think it needs to be a really, really good project to get funded now. Capital has as much power as the rocks in the current state of the oil industry.
Yes, and it's a important dimension, and we all have to abide by it. I think we in the oil and gas industry, we as Galp, we are playing that role in the energy transition, and at the same time, I think we are cognitive that we have to continue to improve our equity story, and to make sure that our investors are behind us. So it's really appreciated your comments, Ben. I have several questions already here from the audience, and I'll try to package them into 2 themes. So one theme that is coming up, we have been discussing the role of energy companies and oil and gas companies, and one theme that has come up is the supply chain. So, and there are some specific segments where people are asking questions on the rig market and the offshore market. So if we as oil and gas investors, we want to continue to focus on resilience and reduce costs, how do we anticipate that the supply chain will evolve in the current terms, both in terms of prices and also potentially in terms of restructuring? And I would leave this question for Tom and Paul. You feel free to share your thoughts, and Ben, as you wish.
Sure. Do you want me to jump in first, Tom?
Yes, please, Paul.
Yeah, go for it, Paul. Yeah.
All right. Well, I mean, there's a number of ways to think about this. I think it's important to think about the supply chain in 2 ways. One is the industry of the supply chain and then the individual companies, right?
Yes.
So the industry, the supply chain itself can put itself in a stronger position through consolidation, as in any industry in a difficult time, including upstream, of course. The challenge I think we're seeing is that where there have been efforts in the past, in the last years even, to bring companies to be partnering, to be combining, sometimes bringing the digital skills along with the more engineering skills. Those setups have had mixed success, so to speak. And now we're going to an era where all the players, more or less, have got low returns and really tough times ahead. And simply consolidating isn't going to be enough. There has to be innovation in the way in which products and services are bundled and are thought about. It needs something very creative. There are certain segments within the supply chain that seem to be more vulnerable than others. The segments which are more, if you could say, more standardized or say less technically focused, less specialized, and some of those also facing a lot of competition from new entrants. So for example, in this area of seismic, area that many of us have been quite close to, there's a lot of good competition coming from Asia now in that area, and it's really going to be a lot tougher for all those companies to survive. There is going to be a fallout. I think one other quick thing I would just say is, sometimes when we think about supply chains, it helps also to think what the future supply chains will look like. In a new energy environment, there are new types of players that are looking at the from customer through to the manufacturing, so to speak, whether that's in biofuels or in the retail sectors, the EV sectors, and so on. And some of those companies are going to develop very strong balance sheets and could become very prominent all the way through the chain. So you could see a sort of a shift in the with certain larger digitally oriented companies coming in, who are doing their business and soaking up, if you like, some of the traditional businesses as well.
Yeah, I think I'd agree on the consolidation front, and that as margins get squeezed, consolidation is a likely outcome both in the service sector and with oil and gas companies. Maybe one thing I would add is in the same way oil and gas companies have to rethink their business models, and so will the service sector. And increasingly they'll be looking at higher growth sectors such as new energy, petrochemicals, areas where we see strong growth out to the 2050s and beyond. So I think you will see some of these players shrink their oil and gas operations and move into some of these higher growth markets in a response to these very challenging circumstances, and an environment that could become more challenging because of all the things we've been discussing today.
Yes.
I'd just add one comment, if I may, Danny, which is from the financial side. If you think of the service sector, and in particular the asset-heavy service sector, the drillers, the OSVs, in the last downturn, investors fudged it. And what I mean by that is they extended more credit, they amended the loans, they punted the decision, and so they half fixed the problem. This time round, it's different. Most debt investors realize the problem now needs sorting, and they'll take the associated pain. So having created some kind of debt zombies for the last couple of years, who have been over-levered, but still have, interest expense in their income statement they need to make up with revenue, a lot of that debt will now get converted into equity, removing the interest line from the income statement and kind of reducing their cost base. But you'll go from having unwilling debt owners to unwilling equity owners. So although the cost base may reduce a bit because they don't have the debt, you still do not have the right, or may not have the right, dynamic ownership who want to invest in those companies. But they will look different in a few years because the whole drilling sector will get delevered.
Thank you, Ben. And while you are at it, time is flying by. I really appreciate this conversation. I wish we could spend more time together. I have here one question that I think it comes in sequence of Ben's reference to Tesla and ExxonMobil, which is in a way, what is the company that can, or how energy companies can lead and in a way compete with these alternative models of business. It's a quite broad question, but is there any way that the oil and gas and energy sector can compete with those alternative business models?
Let me just make maybe one comment on that. I think the first thing is, no company has a right to move into new areas which are very far away from their current business and expect investors just to say that's fine. So there's a real duty on companies to explain why they have the skill set to move into these new areas. And it comes back to what I said, the quality of communication to investors will have to fundamentally change to retain investor trust, to give measurable targets, and to help explain how those capital allocation decisions are being made.
Well, one thing I might add, we've talked a little bit about the potential for a tighter market emerging, and we shouldn't underestimate the potential for cash generation from oil and gas portfolios when they are in harvest mode. So if you think there's a strong chance of oil prices being $60 plus for the next 15 years, the oil and gas companies that move into harvest phase, cut back on investment, but really milk their existing asset base, they're going to be generating a lot of free cash flow, particularly for those players that have reset their dividends. So that gives them a lot of financial capacity to make this shift into new energy. And we have to remember, it's not something that's going to happen overnight. This is a multi-decade journey. But an oil and gas business in harvest mode at sort of prices that we thought were fairly realistic until 3 months ago is very cash generative for at least 15 years.
Yeah, I think building on that point as well, that makes oil and gas companies very viable partners. So you think about the industry, or if you like, the microcosm around the industry. It's not the oil companies and then the alternatives over here, which have got different business models. It can be a collaboration between the two. So, and of course we already see that with the sort of the collaborations and joint ventures around new business areas and clean. So actually, I do think that the large companies have got that going for them. They're not going to go on their own into other parts of the energy chain anyway. The new players in the chain need the oil company, so that there could well be a sort of nice equilibrium. I've got to give some optimism, to the oil and gas.
And it's well taken. It's well taken. So it's with that note of optimism that I would like to thank you all, Tom, Paul, and Ben. It has been a great privilege for me to be here with you in this forum. Thank you a lot for taking your time to be with us. It's a pleasure, and for sharing with your thoughts with us. I think one dimension it was touched is communication, so we understand how to value what we as an industry is providing in the energy sector. And I really appreciate that we are doing this type of communication to a large audience. And I would like also to thank the audience for being with us and sharing their questions, very valuable questions, much appreciated. And also to the organizing committee for the actively putting this event into place. So it is a pleasure. I'm looking forward to see you all again next year, hopefully in different conditions and face to face. Wish you all the best. Stay safe.
Thanks very
much, Daniel. Thank you.
Bye-bye.
Bye.
Can you hear me, Alex?
Yeah, Steve, I can hear you.
Hi.
How are you doing?
I'm good. Seems to be quite busy over there in those rooms.
Oh, yes. Seems to be a lot of parallel streams, huh?
Definitely.
Yeah. Where are you based?
Theoretically, I'm in Nuremberg, but physically I'm in Düsseldorf.
Düsseldorf. I'm sitting next to Düsseldorf. So do you know Wuppertal, Schwelm? So
Wuppertal, I know. Yeah.
Yeah, and I'm in a small village next to Wuppertal. So I'm living here.
Okay. But
official
location
is Essen. I'm living here, and so home office is key at the moment.
Definitely. But your office is where normally? In Essen?
I'm located in Essen. Well, we have Essen, Bonn, Karlsruhe, and some guys are located in Nuremberg.
So good morning, Steve and Alexander. So you both are based in Germany.
Yep.
I'm here in Rio. Thiago Monte. I'm from the department. They invited me to be the host today here. It's a pleasure to have you guys here.
Thiago, are you here?
Yeah, I'm here with Alexander and Steve.
Perfect. So good afternoon to everyone. Welcome to the 7th Galp Open Day session. We have 4 rooms running in parallel, all with very interesting presentations, and you are free to move between rooms. At the end of each presentation, there will be a Q&A session. You can make questions during your presentation in the Q&A chat that you can find in the right side of your screen with a question mark icon. Also, to enlarge the streaming window, you should press the slide buttons. As a chairperson of this session, we will have Tiago Monte. Graduated in Control and Automation Engineering at Universidade Federal de Rio de Janeiro and a master's degree in Petroleum Engineering at Ellacot University, Tiago has more than 8 years in the oil and gas industry in offshore and onshore positions. With Galp since 2014, currently works as a well engineer at Petroleum Brazil in ultra-deep water Santos Basin pre-salt joint ventures projects. Please welcome Tiago Monte, and the floor is yours.
So good morning, people from Rio. Good afternoon, people from Portugal, and our friends from Europe. It's a pleasure to be here today and being host of this process optimization session. So for this first presentation, I have the pleasure to have Alexander Mankel and Steve Baudry. Alexander, after his education as an industrial business management assistant, devoted himself to the study of industrial engineering and management. With this foundation, he started his career as an international key account manager in an ambitious software company. In this role, he was, among other duties, responsible for gaining recognizable market shares in the area of integrated engineering systems for the process industry. Alexander advanced from key account management to head of sales and was now in charge of the development of new regions and key customers in those new markets. This went along with the ramp-up of various subsidiaries worldwide, including market strategies and business planning. The gain experience and active international network he built helped him in the decision to accept a new challenge. Since 2018, he's now acting as strategy portfolio manager for Siemens industry software with the focus on the digital twin process industry PlantSight. Steve Baudry, hands-on entrepreneur, developer and grows new business within organizations, enjoy turning a vision into a successful operation business, experience in operations and project management and business development, mainly in a solution and service business, complements this with a business and financial background. Currently leading a global high-performance team of consultants, engaging end customers in their digital transformation, seeking to maximize their investments in digitalization by proposing tailor-made transformation roadmaps, approach focus on operation improvements via critical levers such as asset performance, operation transparency, time to market, product quality, energy efficiency, and productivity, leveraging new technologies such as industrial Internet of Things, 3D printer, edge, cloud computing, data analytics, software modularization, etc., and implementing them in an existing IT/OT landscape. So please welcome Alexander and Steve for this presentation called PlantSight, One Complete Digital Twin for the Process Industry, how digital consulting is enabling.
Yeah, thank you. So I think I just take over, right? And just give me a hint if you can see my screen. So I start to share it right now. And just give me a quick hint if you can see that. Do you all see my screen or?
I can.
Okay, very good. Thank you for the feedback. So with Siemens, and we are offering a software portfolio talking about the digital twin for the process industry. So it's one twin for an overall asset, for a fleet of assets, and that is what I'm going to present you during the next 10 minutes. And then my colleague Steve will introduce you to how do we make it successful? So how to guarantee project success instead of wasting project money in an IT project setup. So that will be a really interesting session, interactive session, and we see how this will go on. So it's all about managing assets in a more efficient way and managing the complexity, which is, let's say, causing between engineering and operations. So the typical handover process of engineering data to operations and vice versa to have a closed loop. And this is what I'm going to discuss with you or present to you during the next 10 minutes and then hand over as said. So as we all know, complexity is on the rise, especially for our capital assets we are running out there in the world, especially in the oil and gas industry. It's a big challenge in regards to complexity of information, increased regulatory measurements we have to fulfill. The cost position is actually a big driver. So how can we be more efficient with a lower oil price? So that is a compelling event at the moment. And this is, let's say, competing with the reduced response times we need. We have a challenge in reduced staff counts. So also here we have to be more efficient. And finally is really to manage this complexity in all of our tasks we are managing during daily operations of our valuable assets. And it's quite for sure that we need more and new technologies to manage these challenges. And Siemens on a global scale and as one of the major topics in the DI strategy has developed a solution called PlantSight, which is offering a digital twin for real process industry plants. We are having customers in the oil and gas industry, but also in the chemical industry, petrochemical industry, but also serving our customers in the pharmaceutical business, having, as you know, the huge demands and regulatory, let's say, challenges in being sufficient over there. And with PlantSight, you have exactly one digital twin showing exactly what you have there in the real world with your real asset. And we offering all of the involved people just different views to this digital setup here to make better decisions, to get the real validated information about the overall life cycle. And that is an extremely important thing, that you have got one data source, one portal where you can grab all your information in, where you can collaborate with your colleagues and make, let's say, run your plants more efficient, run them more safe, and be overall increase the efficiency of your assets. That is the topic. So if we dive one step deeper, PlantSight is bringing together these design data with the real performance data of your assets. So on the left-hand side, we see the virtual plant being built up with the 1D, 2D, 3D data. In the pharmaceutical business, we are talking about today also adding the building information model to this twin. We add the simulation data, design data, and then we combine it in this information model here with the real-time data of your assets. So it can be the alarms, the real-time data from the TCS systems, historical data, And all this is embedded in a closed loop to keep this set up, this digital twin evergreen. So there are algorithms, it's artificial intelligence-based setup that you get really the opportunity to keep it evergreen and not only, let's say, have it once a time as built or as operated, but with your daily work, you support the system and keep it in as operated. So, and then you can have different views, what I explained right now, to your real asset through the digital twin. On the left-hand side, we see the engineering view, so the asset portal. Here you can grab out all relevant engineering data, so the 1D data sheets, the 2D P&IDs, for example, interconnected on the right-hand side with your operational data. So what you get from your critical asset, for example, for asset monitoring and fleet management. Then we have the process performance management view, so the real production optimization. So let's imagine we have a shortage of a compressor or a failure. So how do I have to react? So what about my overall performance of the plant? Do I have to start flaring, or can I reduce the capacity of my plant and open up a maintenance window to get a quick and fast repair? Or does it even matter? I can run my the next couple of hours with a 60 or 70% run case because I cannot sell all my product at the moment what I'm producing, but therefore it's quite a good timing of doing this maintenance job, which was maybe scheduled in 2 weeks' time, just to pull it to today's operations, and then increase later on the quality of your production back again, save the environment by not flaring and being more productive in the future. And all about these use cases, what you see here on the slide, all of these are embedded in this PlantSight. It's also the operations performance management, so KPI management. We call it in Siemens, that is a strategy from sensor to boardroom. So everybody who has to deal with the plant, if it's the mechanic, the operations manager, or the CEO, he can participate from this twin portal. He can has his or her views to the asset, to the maintenance costs, to unplanned costs, to failures, but also to the actual production quality, or even to the costs which were not planned but came along all in a sudden. So you have really an information portal. And one customer just a week ago called it a decision-making support system. So really have all the valid data at your fingertips and then base your decision-making processes on these kind of data. Either they come from the more static point of view, so P&IDs, the wirings, the 3D models, but also, let's say, interconnected to the real-time data so that you are never lost in your data sources, but have an interconnected and contextualized view into these data. And finally, what we have to guarantee for all of our employees, we increase the health, safety, and environmental and quality of our production, of our facilities, of our assets. So this is always on top. Normally, we should put the letter F and the use case on top of it, because safety and health and environmental is not to be discussed. And going for better decisions based on valid and contextualized information, I mean, it's quite clear that based on this, we can go for the real, let's say, high quality and top quality decisions, can review things, can forecast things in regards to predictive maintenance, and then run our assets in a more predictable and more efficient way. With that said, what is the overall purpose of this solution we are offering here with Siemens around the globe, managing assets and fleets? We would like to simplify the complexity of our homegrown systems, like the ERP systems. Typically, it's mentioned here SAP. We have engineering systems. We have quality management systems, etc., etc. So we combine these systems and map them to the digital twin. So really mirroring the as operated and as engineered asset or plant. And then finally, it's all about to enable everybody and all the teams to look through the eyes of an expert and act accordingly. It doesn't matter on what hierarchy level, doesn't matter of the age. Everybody who is acting in a critical asset, in a critical environment, should get a valid view to the complexity through a digital twin and get his or her informational view to make the optimum out of his daily, let's say, working hours within that asset. So that is really the importance to really enable all of our workforce being an expert, having the right data at the right time, at the right moment at hand, and then base the decision making on top of this. And with that said, I would like to summarize this quick, let's say, presentation here. The challenges are obvious. We have siloed data. For the employees, it's hard to find them. Then we have in our daily operations equipment and process failures, unplanned and not scheduled maintenance cases. And finally, we have a challenge based on this not accurate decision-making processes, loss in safety and performance and quality. So the value we put against this with PlantSight is that we consolidate all the relative and relevant information. We collaborate with all the teams in this data asset portal within the digital twin portal here, offering different views, contextualized views. And finally, we gain all valuable insights, if it's for one asset, if it's for my fleet around the globe, compare things and go for the right decision-making processes. And this ends up in a lot of savings. I don't want to go all these savings in detail, but we have in average improvements of the overall life cycle of an asset's operations between 5 and 10%, what we can also show in showcases and use cases we have already implemented within our customers. And by naming implementation, Steve, it's all about, do it in a trustful way, and talking about, in our days, about interconnection to the cloud, edge computing, digital twin. Siemens is one of the big drivers of the Charter of Trust, so that we also take care in regards to cybersecurity, that we respect the data centers of our customers, that we act accordingly, and therefore Siemens has also signed the Charter of Trust for this important topic here, secure the digital world. So that is a high topic highlight for Siemens, and that is what I would like to name here. But it's nothing if we cannot make these kind of projects successful. And therefore, Steve, I would like to hand over to you, talking about how is Siemens, let's say, nearly guaranteeing that we launch successful projects and not wasting a lot of project money in finally delivering no value.
Absolutely. Thank you, Alexander. I'm going to share my screen right now, if someone can confirm that indeed it is working.
Mm-hmm.
Can you see now my screen?
Not yet.
No, we see you, Steve.
No, you see me. Okay, that's nice, but that's not enough. Let me say that again. All right. Now?
Yes.
Here we go.
Yeah, now we can see.
Yes. All right. Very good, very good. All right. Thank you, Alexander, for the introduction and the presentation. And I'm sure that the audience have, along those 2 days already, the opportunity to see a lot of different technologies. Amongst those, PlantSight, of course, have a specific point to make when we talk about digital transformation. And rightfully so, as you said, there are many technologies around and many opportunities to engage a digital transformation. But I'm sure that the next step is really to think of how can I do that? I mean, where do I start? Because you've seen already, as I said, during these days, many interesting technologies, and then you have to be sure to take the right one. And then probably the questions that are popping up in your mind is like, where do I start? Which technology should I implement first? Which is not for me? Which one is maybe to be implemented at the second step, and so on. And this is where digitalization or digitalization consulting or digital transformation consulting is kicking in. Before going into really the core of this, let me share with you a most common questions I had when we are talking to our customers, and then they are saying, "Hey, why should I do this consulting? I mean, at the end, I just can pick a couple of pilot projects, or I can pick a technology that seems to be good to me, and then implement it, and then I will take the best outcomes of all these pilots." Answer is that it can be like this, but to explain a little bit why consulting is interesting, when we talk about digital transformation, I like to use a metaphor to speak, and let's consider that the asset or the rig that you have or your plant as a house, and now you want to refurbish this house. Then of course you have the first option saying, hey, I'm going to do that by myself. I'm going to pick the different equipment, I'm going to pick the different materials, and I'm going to renovate it. That's an option. And then when you go into this direction, you have to masterize a lot of topic. And then again, with this metaphor of renovation, you need to understand piping, you need to understand electricity, you need to understand plumbing, you need to understand as well all the drawings to make sure that the kitchen will have the right side and so on and so on and so on. That's good. But you need to have all these skills to make sure that you are getting the right results. And again, with this metaphor, sometimes if you are making some mistakes because you don't have the experience in some part of the construction requirement, then you can end up into some, let's say, tricky mistakes, or in other words, costly situation where you could have lost a lot of money and you have to restart again. And as you can see on the screen here, in a more or less funny way. Now back to the consulting. That is exactly the same thing. You can also go for the option number 2 when you are talking about this house, when you can say, hey, I'm going to use an architect. And then this is what we are proposing when we are talking about digitalization consulting, digital transformation consulting. Many customers have different way of, or it's a different goal when they talk about digital transformation. Some of you might say, hey, listen, for me, digitalization is only improving my data analytics. I have a lot of data, I just want to improve that, and everything should be related to that. Some of the customers we've met, they say, hey, I want to go to the next step of digitalization. I will only pick projects that have a payback time under 3 years, for example. And some others might say, hey, my automation network is perfect. I just want to focus on IT projects to make sure that I'm going to the next step. So you see, that there are a lot of ways to go for digital transformation, and therefore a lot of ways to be lost or to take the wrong way. And as you can see as an illustration on the right of the screen, 40, let's say 50% on average see that there is a potential in digitalization, industrial IoT, and so on, but they don't know where to begin. In other words, they don't know where to implement. Second is that unfortunately 60% of these customers that have undertaken digital transformation through proof of concepts, through pilots, and so on, actually did not reach their goal, which in other words is estimated at 900 billions of waste in the wrong investment. That's why consulting is really like the architect, showing you the right direction, making sure that it's compliant with what you have installed already, what you have as an install base, and what you want to achieve in terms of strategy. Then you can also do that by yourself as a customer, but here again, digital transformation is requiring to be successful. The first one is, when we talk about digitalization, we talk about automation, we talk about IT, and also we talk about process know-how. Because the way we implement something on a rig or on a platform, or the way we implement something on a chemical plant, with all the regulations around and all the constraints to the nature of the industry, have to be taken into account. Again, we need to have, or you need to have a process knowledge here around. It's like, we cannot do the same thing on a process that is dealing with explosive material as if it is dealing with a piece of wood, to make it simple. You really need to have an industry background. What I mean by this is some technologies are very mature for some industry. For instance, blockchain is a very accepted and mature technology for food and beverage. It's not yet here in chemical, petrochemical, oil and gas. Again, here you need to have the right framework of what is possible and what is just a leap of faith, so to speak. Of course, you need to have the skills in the change management, because it will be anyway be implemented on the running asset. And therefore, here you need to handle how you're going to push those technologies who are going to have an impact on the people. And last but not least, a structured methodology is making all the approach of digital transformation faster. If you have already implemented twice a digitalization strategy, then you are probably more keen on having a structured way to make it faster. And of course, all these pillars are relying on what you see on the bottom, this experience of digital transformation. Of course, you have always, let's say, opposite views on digitalization, or how to define the project that will fit into this. One of them is the bottom-up. It's really like from the operations, seeing the problem and bringing a project. And then the other way is more on an holistic perspective from the strategy. We will say, okay, that's the market trend. That's where we need to go. What are we doing? And then a right consulting project on digitalization should combine those two views to make sure that we get the buy-in from the operation on the field, and then we get the buy-in, of course, from the strategy part of the company and the financial part. So here, as I said, there are some companies who did or tried and did sometimes successfully that by themselves. The other option is to go through a third partner, and then here in Siemens we have been doing this consulting in various industries across the world and since a couple of years already. And then what we propose here is what you see here on the screen. I mean, first of all, Siemens has a substantial domain know-how in different industries. We have been there in your industries and in the others since a couple of decades. We have this possibility to have a multidisciplinary approach. We have IT experts, we have automation experts, obviously, and then we have our process experts who really speak the same language as you and who knows what are your constraints when we are talking about making a change on an oil rig, for instance. Implementation-wise, as Alexander was saying, we have a global footprint, so here I don't need to elaborate. Important here is that the team we are having is not a sales team for the Siemens portfolio. Of course, we are having the backup of the knowledge of the Siemens portfolio, but what we deliver when we do a consulting, since it's a paid service, we deliver completely vendor agnostic. So here we give you the specification of what should be done and how it should be done. Then on the same line, our team is around about 300 plus consultants spread around the globe with different peaks in terms of skills. Some of them are more on the strategy, some of them are more on the operations, and of course, every project being different, we are just teaming up depending on the context. Technology leader and end-to-end solution capabilities, it's what Siemens stands for. I don't need to explain that we are a company at the edge in terms of technology, as Alexander again showed us today, and end-to-end implementation thanks through our different solution centers spread globally. As a conclusion, this is what we get. Our objective, and a summary, is to bring you from where you're standing in terms of maturity, so to speak, to the level of having in your hand an RFQ-ready document that you can go on the market, and then you can start implementing. And then with this RFQ-ready roadmap, you are sure that the investment you are making or that you are doing are maximizing the capital allocation. That you are sure that the project we have defined for you is the one that is fitting into your existing install base and that is future-proof. And as our conclusion, all these projects, as you see on the first slide, are completely interconnected. If you start modifying the IT, then you start modifying the cybersecurity aspect of this IT system. Same is valid for automation network as well. So all these projects being interrelated, what we give you as well is the whole roadmap over the 5 years of what are the projects, what should be implemented, what are the costs that you should foresee on that, and what are obviously what are the financial KPIs related to ROI, the net present value, and all the financial data for validating those projects at an investment level. So that's the approach we have, and with that, I'm finished in this presentation. And I think we can now open the floor for questions to Alexander, to myself.
Thank you, Steve. Thank you, Alexander. I think we almost run out of time, but then I'll make one question, a quick question. I really liked what you said about process know-how. I think if you don't know the process, the digitalization process is just about data, and about data you can interpret anything. Have you ever had an experience of that? Any case that people were not used to the industry and come up with a wrong conclusion working on that data?
Yes, we had, not us, but we had customers who actually came to us afterwards because they were disappointed by data analytics services from other consulting firms. And that was exactly the reason. They were just taking data, putting them into the big machine, to keep it simply, of course, and actually coming with unrealistic results for this industry. And that is very important. And that's why I believe that Siemens is well positioned for that, is that we have been working in this industry for decades. We have been implementing solutions. We have been developing new technologies. So we have to understand what are the constraints, and most of our workforce is actually coming, not most, sorry. Some of the workforce is coming from this industry. And that's critical. That's a critical point, perfectly pointed, that we need to have when we have an approach of digital transformation.
Fully agree. Thank you. Thank you, and Alexander and Steve for this good presentation. And I think now we are going to move to the next one. So the next one is going to be presented by Michael Ojukwu. Sorry, how I pronounce your last name?
Oh, it's Ojukwu.
Ojukwu. Okay, so
Yeah.
Michael is a senior petroleum engineer at Schlumberger. He holds a Master of Science in Petroleum Engineer from Imperial College of London. In 2005, he joined Schlumberger as a wireline field engineer and transitioned his career within the company as a petroleum engineer with software integrated solutions. Earlier technical roles involved consulting projects, client support, technical training, and workshop delivery. Currently, Michael works in a business development for production engineering solutions. So thank you, Michael, to be here. And the floor is yours to present the presentation called Automated Well Portfolio Optimization, Leveraging Digital Technology to Accelerate Well Intervention. Thank you.
Okay. All right. Thank you, and good afternoon, good morning, good evening, everyone. So thanks for the introduction. In this presentation, we'll be talking about the automated well portfolio optimization. Okay. Now, this is the agenda. First of all, I will introduce, certain challenges that we have and value proposition of this solution. And then I'll give an example of a generic workflow which involves rapid candidate screening. And then I would talk about how this well portfolio optimization ties in with our overall Delphi products alignment, and then we can take a few questions. Right, the challenges and value proposition.
Sorry, Michael, I think we don't see your presentation.
You don't?
Oh. No, at least I don't see it.
Let me just hang on.
Share the screen.
Share again.
Let me share it again. For some reason it disappeared. Just hang on. Sorry, just a moment.
No problem.
Now we can see.
Okay, so if I go to presentation mode, can you see it now?
Perfect. Thank you.
Okay. Right. So I was talking about, let me just go through the agenda again. So we have challenge. I'm going to talk about challenges and value proposition, generic workflow. An example is the rapid candidate screening, and then how this ties in with Delphi products. And then we'll take some questions and answers. Now, the identification of potential workover candidates, usually, in a lot of cases, this is a manual, tedious, and repetitive process, taking a lot of time and for the engineers trying to select which wells do we want to perform a workover in. And of course, it becomes more challenging the higher the number of wells that you have to deal with. And another thing is that in a lot of cases that we know in the industry, best practices and lessons learned from previous interventions are not easily captured. Therefore, we are not leveraging those best practices in order to improve feature candidate selection methodologies and choice of intervention. Okay, so these are the basic challenges we normally have. So one, it tends to be a manual, tedious, and repetitive process. And secondly, we don't capture those best practices in order to improve the process moving forward. Now, what we propose to this well portfolio optimization, and the course of this presentation, just permit me, I'll be using the term WPO to stand for well portfolio optimization. it allows us to manage our wells in a very proactive way. Basically, we're trying to make sure that the opportunity pipeline for intervening in our wells is always maintained full. So we don't want to be reactive, we want to actually be proactive. And this is what we call an opportunity maturation process. All right. Secondly, this solution is an advisory system, basically providing us with a standardized and automated approach to rapidly screen and rank hundreds or thousands of wells. So what we're trying to do here is that not just selecting wells for workover, but to be able to rank them in a certain way, of course, knowing that we have constraints on budget for a particular year. For example, we want to be able to select the wells that will give us the most return on the workover investment. And then finally, this is a knowledge-based framework, meaning that it's not just guesswork. We are combining three main things. One, petroleum engineering best practices, things that in the industry we are already familiar with in selecting wells for workover or intervention. But then, most importantly, is the second point. It applies advanced algorithms in order to, that is where the automation of this process comes into play, in order to be able to identify, signatures in the well behavior, and that is where data analytics comes in. And then lastly, it employs business logic of the client. So whatever your business logic is, budget constraints, all that can be applied in the system in order to, select and rank these wells. Now, this goes through different stages. On the y-axis, we see human interaction, and the x-axis is the opportunity maturation. First of all is the screening. So what we call rapid screening, being able to identify underperforming wells, make recommendations, what potential gain are we going to get, and very importantly is a chance of success.
Sorry to interrupt you.
Yeah.
Can you turn off your camera, because the microphone is with some interruptions, and I think it's the connection.
Okay, so I'm going to turn off where is the camera? I need to exit the.
Now the microphone is okay. I don't know if.
It's okay now. Okay, yeah. Let me. But do you still want me to turn off the camera?
Okay.
Okay, let's go back again. Can you hear me now?
Perfectly.
Okay. All right.
Thank you.
So we said, the first one is make the screening, rapid screening, make chance of success based on historical look back. Secondly is the in-depth evaluation, so that when the wells are selected, it still needs to make an in-depth evaluation on each of those wells in order to develop business case for the selected wells and prioritize them. And as well, it generates a comprehensive report. The stage 3 is the approval rejection. So this system allows for someone to approve or reject the proposed candidates, okay? And actually can make recommendations of, okay, we need to change one or two things and select a different well. So the opportunity can be sent back to the screening pool or escalated for stage 4. And then stage 4 is to plan the intervention. Of course, this involves detailed job design, planning for the logistics, risks, and mitigations. And then for the execution, this is also tracked in the system. And the final step which we introduced is something called the look back. This is now the point whereby after the execution has been done, the system also allows to compare the actual production with what we planned as to be intervention, in order to enrich the knowledge base and improve future rapid screening. This is just basically, if you're familiar with the concept of machine learning, for example, so basically training the system to improve the recommendations it makes moving forward. So this is a hybrid decision support system. Basically, like I said, it's proactive. Everyone in the asset team are always aware of the intervention opportunities. It's standardized, systematic approach, measurable time savings and accelerated recovery. The candidate identification and prioritization, we have certain things like workover interventions. If there are some idle wells that need to be reactivated, behind casing opportunities, as well as artificial lift type change. And then when it now comes to the automation and analytics, it's basically working with trend detection, pattern recognition, being able to interpret the signature of well performance, automatic decline curve analysis, and then all these fits into the multi-criteria decision-making process. So all those key 4 main areas as in the business logic, basically, what are your business logic for each client? It will be different for different companies, but this will be implemented in the system. The petroleum engineering domain, basically the best practices that we are very familiar with in the industry. Now, the 2 aspects on the right, the automation part and the analytics part, is now leveraging the more modern digital technologies into this WPO process. Okay. Do you still have my audio?
Yes, you do.
Okay, all right. Now, this is a generic workflow which involves rapid candidate screening. So we have decades of petroleum engineering best practices. For example, there are some analyses that we used to for analyzing wells, from using the type wells of, P10, P50, P90, heterogeneity index plots of oil and water, pressure and liquid, chant plot analysis for water breakthrough analysis, water cut versus time, forecasting, EUR, remaining reserves, nodal analysis for well performance, rate transient analysis, hull plots for well injectors. These are things that, we're used to as petroleum engineers, and we've been doing this for so long. And then we also have the moving domain centric that basically involves maps, bubble maps and grid maps of different production parameters, as well as petrophysics analysis maps of net pay, porosity, oil in place, KH. And then we have the reservoir block layer-centric analysis, basically involve things like, average reservoir pressure trends, drive mechanisms for material balance, recovery factor, fluids in place, fluid contact, etc. So all these analyses are things that in the petroleum engineering business we are familiar with. So basically what we're now trying to do is that instead of doing all this manual analysis, which we have been doing for so many decades, is now to be able to automate them and leverage digital technologies to make it more efficient and capture all this knowledge and improve the recommendations. So that's where the automation and analytics now comes into place. So for example, to determine wells that are underperforming, we use things like heterogeneity index, type wells, decline curve analysis, aerial trends, field key performance indicators. We factor all these things into what we call a multi-criteria decision-making process in order to select our workover candidates. But then to do this, each wells would have their own constraints and recommend interventions, such as water constraints for the wells, completion constraints, formation damages, and all this fits into to recommend which workover type based on what the issue of the well is. So selecting the candidates, recommending which workover type, but then the last thing now is to prioritize based on how profitable or the economic viability. So using historic intervention knowledge and also post-workover forecasting to calculate the net present value and now come up with the final ranking of the wells. This is how the system automates, more or less automates the whole process. So the output visualization example as this, where on the right-hand screen, so basically what you're seeing here is the list of your wells, the status of the wells based on what the NPV is, okay? Whether the NPV is within budget, outside budget, or within budget. So it's ranking it based on green, yellow, red. And then what are the constraints for that particular well? What is the certainty of the analysis? The recommended workover type, be it reperforation, stimulation, water shut-off, zonal isolation, etc. Of course, gives you what the NPV is and the incremental production from that recommended workover. And then the other screen we see here is the plot. You will be able to get, some forecasting plots, the plot or the analysis that feeds into the decision for each particular well. You'll also be able to see all that in the system. Now, I mentioned earlier on that we are tying this in because into an overall Schlumberger Delphi story, okay? So I just have one slide here just to explain what Delphi is. I'm not going to go into it that much. But basically, for the past 3 years, we have been going on this digital journey in Schlumberger, where what you see here is to have a system that all the different domains, exploration, field development, production, and data. We have this called the data ecosystem now using the open subsurface data universe, where we have geoscience data, reservoir engineering data, production, etc. Okay. With this, focusing on production, because this WPO, which I'm highlighting, sits on the platform we call products here. So we have all this data that feeds into what we call a data ecosystem from depending on the different data types, from sensors, mobile data capture, file historian, CSV files, well file models, etc. Then WPO sits on top of this product system. And the idea is this, right? That for this WPO, it allows you to have a collaborative canvas such that all the asset members have access to it, and it breaks down the silo between teams. Because what we know happens in a lot of cases, of course, this would not be the case for every organization, but sometimes you find out that, you have reservoir engineers, the well engineers, the petrophysicists, everyone doing, maybe in different offices or doing their own thing. But this now breaks down this silo between the teams such that you'll be able to track the status of each particular well. So for example, what you see here is, there is a tracking of every changes made in the evaluation of each well, okay? This particular screen for the recommendation that was made, it was submitted for review. There will be an asset manager that can, review it, or a reservoir engineering manager that will review it. If the person has a comment, a person can make a comment as well. And then notifications for each of the different levels that have to reevaluate an analysis or to review an analysis, etc. Also, it provides users with meaningful insights and recommendations to allow them for quick decisions and take actions. So it allows you for each particular one. So for example, on the screen here, you see on the right, you find the wells, what the status is, okay, what the constraints, as I've showed you before, and where the NPV ranks in a particular quadrant. So if it's high NPV versus incremental or decrease in production, then it allows you to know which wells to take accounting for. And for each particular well, you would see what are the evaluations and the certainty on each of those evaluations, okay? So for this particular well, for example, it says it's channeling. And this is a recommendation. So the system would recommend zonal isolation based on the previous analysis. And of course, also showing you what the statistical probabilities of this is. For example, P10, P50, P90 for the recommended post-intervention projection, as we call it. Right? Now, very importantly as well, it allows you to track the work you're doing and the activities from inception to completion, saving all your data in the background. So for each of the wells, you will see different stages. So it goes from evaluation, approval, planning, execution, and then execution complete, evaluation close. So you were able to see in the system all those wells where they are in the process. And there is an action column here at the last part. So if there is a need to review a particular well, that button will be there. If they're ready for review, you click on this button and then that well can go back for review. Furthermore, for each of the particular well and for particular intervention being proposed on each of the wells, what you see here is projected production. The x-axis is time into the future, so that for each of those workover performed, there is a projected production increase for the entire asset based on the workover performed moving forward in the future. And then finally, it closes the feedback loop. So for example, here you have that there is a warning, okay? A warning here is that you can dismiss a particular opportunity. Of course, you have the reason, why am I dismissing the opportunity if it's incorrect or it will take too long. So the point is the fact that the system recommends something or a certain walkover or a certain reason why the well is behaving the way it's behaving doesn't necessarily mean that it has to be accepted. It also has to go through a review process, okay? And then review constraints. You can pick a new constraint for the well and give a reason, finish review. And finally, the manager of the asset can approve the submission and that review has been finished, and then it will go through the next step of, for planning and execution. So to summarize, this is an advisory system. The good thing is that it provides a standardized, proactive, and automated approach in order to rapidly screen, not just to screen the wells that would require workover, but also to rank them based on economic viability or whatever the business logic of the organization is. So it's a knowledge-based framework integrating petroleum engineering best practices, data analytics, leveraging digital technologies that already exist, as well as business logic for different customers. Right? So this brings me to the end of the presentation, and we can open up for questions.
Thank you, Michael, for a very interesting presentation. For the question, I'm reminding the audience that they can send the questions. I have one here, the one from Bruno Levy, asking if the well portfolio optimization incorporates anything related to well integrity to do this workover decision.
Not at the moment, not for the well integrity, no.
Okay, so it's just based on production output.
Yeah, so not only production, so there's production, but also the input. In one of the previous slides I showed you, right? Some of the, let me just go back to here. So some of the input as well is also like petrophysics data, material balance and all that, yeah.
Okay.
Okay, but one thing when it comes to for example, the well integrity part, okay, that's something else that we can enabled in the system. But at the moment, these are some of the items that we are working with. But we're always improving the system to encapsulate as much as possible.
Because for sure, well integrity is one of the constraints of workover selection. That's why I think it's a good question, and it's also a good improvement for the system.
Not well integrated in the sense that, so for example, when one of the in this process, I just kind of skimmed through this. Let me just go here. So in this slide that we are looking at here, right, the step 2, which is in-depth evaluation. One of the things we do in this particular stage is to do in-depth petroleum engineering analysis on certain wells. So you have a ranking, a list of wells. So the system, being in Delphi and also having well models in them, allows the engineer to do well performance and analysis on a well-by-well basis. So that is something that is done in, I wouldn't say offline manner, but that's when it comes to in-depth evaluation, then it also requires the engineer, because we don't allow the system to do everything. The engineer has to, if there's a well model, to see, changing the tubing size, what that would enable. But that would now involve stepping out of the system to use one of the other well performance softwares to check if the recommendation makes sense, or if there's something better that can be improved with the recommendation. So it's not just click and allow it to run. Yes, there's the stage 1, which is rapid screening, but then the in-depth evaluation and the review now allows better analysis of each of the top, let's say, ranked wells, for example.
Thank you, Michael. I have another question regarding the intervention planning. This is basically a database from Schlumberger with common interventions, and it's just suggesting, or it should be something operator based with the operator procedures that you just on the selection criteria, using one of those and proposing this to the engineers.
Okay, so let me just with that, I think it should be here. Okay, now for this particular screen, right? So you're right. So in the system, we have configured, for example, when it comes to it's not shown here on this screen. So I'll give an example. When with the champ plots, right, with water production, it can be, based on the signature of the derivative plot, it can either be coning or channeling or near wellbore breakthrough. So if it's coning, it's now being configured to suggest, say, water shutoff at the lowest perforation. Or if it's channeling, then it can be like, flowback or different things. So it's been embedded in the system. However, just like you mentioned, you can also include, based on, because all this is it uses some programming that is done in the background and scripting. So if based on your previous experience and how you work, and that's the good thing with the system where the client's business logic comes into play. So it allows for customization based on what you as a company do for different problems. Okay, so there are the set of recommendations based on historical best practices, depending on what the problem, how the well is behaving, but then you can still implement yours, or rather your own intervention solutions based on what you prefer can still be implemented in the system as well to give you the recommendation. But let me also reiterate that regardless of what the recommendation is, the system also allows you to choose a different option such that, and that is where the look back becomes important. So let's say the system suggested a water shut off, and you said, I want to do something else for that well. The look back is such that after the intervention has been done and well has produced, so it trains the system such that next time when there is a new signature of the original well, it can now make a recommendation based on the success that has been achieved with a workover that has been done already. So that's how there's a constant feedback of improving the recommendation that it generates.
Thank you, Michael. Thank you for the interesting presentations and for the Q&A. Now we're gonna move to the next presentation.
Okay.
The next presentation, Vinicius Girardi. Vinicius, I think we still see your presentation, Michael.
Okay, thank you very much. Can I stop sharing my screen now?
Yeah, thank you.
Okay, thank you.
So Vinicius is a business development manager at ESSS, business unit dedicated to software and simulation tools for the oil and gas industry. He has a bachelor degree in mechanical engineering from both the University of São Paulo and in petroleum engineering for PUC Rio. Vinicius' experience spans 10 years in the use of simulation for engineering applications, from 1D multi-phase flow to reservoir simulation. Vinicius works at ESSS since 2011, connecting oil companies, university, research institution to the company in order to develop R&D products related to simulation and new software technology. So please welcome Vinicius to the presentation of real-time monitoring of well life cycle from drilling to production.
Thank you, Thiago. Can you hear me well? Everything is working. You see my screen?
Yes, perfect. Just before you start, just remembering the audience that you can send the questions. We are gonna have a Q&A afterwards. If you don't send it, I need to do it by myself. So please send some questions. You can go, Vinicius.
Okay, thank you. If you have any problems with my audio or if my internet fails a little bit, just let me know, please. So first thing, I would like to thank the organization of the Open Days for inviting ESSS to present in the event. It's always very nice to participate in this forum. And this year, I'm going to bring a little bit more about that we are developing in Brazil to monitor the life cycle of a well since the drilling, which is something that we have been doing for a while already, but we extended to completions and production. So we're going to take a look at these and discuss a little bit what types of things we are trying to monitor during these stages of the well life. I'm gonna start with just two slides for the ones who doesn't know us, and then I'm gonna jump into the technical part of the presentation. So we are a software company dedicated to simulation tools and software development. So have been working for more than 25 years in the oil and gas industry, starting with Petrobras, but now we have been working with all the major companies. We started in Brazil, in Florianópolis, a nice city in the south, for the ones who know Brazil. And then we are now in different countries already. So during all these years, we have been working in reservoir engineering, simulation, advanced simulations in reservoir, post-processing, these kind of things. With Galp, especially in the production and flow assurance area. I've shown last year's past events the advances in our simulator that we are developing together, and in drilling, especially in the real-time monitoring and modeling of drilling operations, and with Petrobras and other companies. So that's how, just a brief introduction about us and why we are working these topics and what we are developing now. So just an intro about real-time monitoring. We all know that's a trend. Companies are tending to bring people from the drill rigs or the production platforms to onshore. So to stay in the office, that it's safer, it's cheaper, you can now, with all these cloud computing speed, a lot of sensors, you can send a lot of data to onshore, and instead of being there, all the specialists on site, you can have a team in the office analyzing all the situation, taking decisions in-house, let's say. So especially at these times that we are facing now, this kind of operation, it's even more important. So you don't need everyone grouped in a single place. You can divide and make safer operations. So this is it's a trend. We see that it's one step to a full automation of drilling rigs or platforms. And we have been working on this for a while. So how these types of technology works? You have a real operation. Here's a drilling rig, but you can be also a producing platform. You acquire a lot of data in this real operation through sensors. You send to onshore, mostly using some standards, like for drilling, you have WITS-ML. For other operations, you might have different standards. Generally, you have a central database or a software that collects all this data, creates all the governance, controls access and everything. And then you have specific operations or specific software that are designed to understand this data and provide analytics and provide insights for the users. We recently, this digital twin became a very big thing. It's the name that people are using to, let's say, to these models, and we are gonna use the same terminology here. So you have a digital twin of the operation, could be drilling, completion, or production. This digital twin have also some intelligence behind it. You try to foresee before the problems before they happen, and tell the operators or the team, the expert team that is onshore, to look, something might be happening. You should take a look. We suggest this and that situation, and the expert sends to the real operation some decision and communicate, look, you might have a problem, please take a look at this. So that's, let's say, a simple diagram how this technology works. And now just a bit of history behind it. We, ESSS, together with Petrobras, we started working more on drilling in that area in 2005. And we have been publishing about PWDA, which is the tool that we developed together since 2009. We have several papers on this kind of real-time monitoring of and diagnostics of drilling problems in real time. But we see now also a lot of articles in SPE journals, in JPT, talking about these real-time remote operation centers. So it's becoming big. It's been a while that this technology has been developing, but I guess we reached to a point where all the technologies are mature enough, sensors, internet speed, network speed, cloud computer storage, they're all coming together to make this possible in a broader way. So just a brief history and complementing the methodology that I was showing in this slide. I'm gonna focus my presentation on these digital twins or these simulators that tries to foresee the problems. So we started with drilling, and we started with what we call the simulation-based approach. So in the past, in 2005, and we didn't have much of this artificial intelligence. The algorithms were there, but we didn't have all the application, the computational power, and we went through this approach that we think that's also good. We cannot forget the basis of the engineering. Everyone is using simulation for a long time, so it's not something that we will will leave. So the pros: if you have a good simulation model, you don't need to create very complex data analytics or digest a lot of data to have your result. You just have an equation, you model the problem. It's quick, it's easy, and you have what you need. The cons are sometimes you have a very complex model. You are not able to simulate that, or if you are able to simulate that, you are not able to simulate that in real time. So you need cheaper models, computationally speaking, to be able to simulate in real time. So you will have pros. If you have this simple model, fine. The cons, if you don't have this simple model, probably you won't be able to create that. And then that's where the data analysis come. If you have a very complex model, sometimes you just need to, you can put out the input data for this model, and this model will, let's say, create some representation that sometimes you are not able to do with traditional modeling, and then you can use the data analytics approach. The cons are it requires a lot of data to do that, and then sometimes you don't have that, or you need a lot of time to acquire these. And so both approaches have pros and cons, and actually we are using both in our digital twins, especially for problems that we cannot model very well or very quickly in the simulation-based approach. So as I was mentioning, we are developing a platform to monitor all the well life cycle. So the PWDA is the software that related with drilling. So we have been working since I mentioned 2005 with Petrobras. More recently, we are working also on the completion operations. We are calling it PWCA, not very creativity, but it's for the completion part. And we are also working on monitoring the production with focus on well integrity, combining these technologies from real-time monitor and AlphaSim, the multi-phase flow simulator that we are developing with Galp. So we are coupling technologies to create a comprehensive platform so you can monitor in real time your well life cycle. So I'm gonna show examples on the three fronts, and at the end, the presentation, we are going to show a little bit about our vision and make use of the R&D call that was presented yesterday by Markwell to provoke a little bit you guys as well. So about drilling, is this, let's say, the more mature tool that we have. We have been monitoring post-salt wells and pre-salt wells, also exploratory wells since 6-7 years ago. And this project also was awarded with a ANP prize, and it has been, let's say, extensively used in Petrobras in their onshore decision sites. So types of examples of things that we can do with this kind of tools. So in drilling, a problem that you can have is washout. So it's like a fracture in the drill pipe that can evolve to a serious damage and the breakage of the column. So you want to identify that and take out the column before you have a more serious problem. And the tool monitoring a lot of, let's say, variables, especially pressure and densities. It starts to compare the data coming from the field, or let's say the sensor data, and the calculated data that we simulate using our hydraulic models. So we see that we say that it should be like that, but when we compare with the field, we see a divergence here. The trends are not the same. So that triggers a lot of analysis behind, like decision trees and what if scenarios. And these simulators calculates and comes to a conclusion and pops up in the screen to the operator. Look, you might want to take a look because we identify that a washout is happening. And we also say where is it, like in terms of it's in the middle or is it in the end or it's in the beginning of the pipe. So you can take a better decision to take out or finish the phase and check later. So that's one type of problem that we are able to monitor. Other things like poor hole cleaning, if you have some bad formation, we can simulate this with our models, and the same thing happens when we see weird things, when the software sees that weird things are happening in real time compared with the simulations. We pops up some advices. Recently, in a new project or in the continuation of the project, we are starting to take a look at the well integrity part. So the wearing of the casing in horizontal or deviated wells is something very important to calculate. So in real time, we calculate what's the wearing along the previous casing from the current phase, and then we can set alerts to say, look, you are approaching serious damage or a serious or amount of removed material that you cannot allow. But we also use the projected or the design trajectory to simulate what would be the final wearing of the casing if you continue the operation the way you are. So that might say to the operator, look, you might want to change your rotation, your fluid, or change a little bit your trajectory, because if you continue like that, you're gonna damage your casing too much when you reach the end of your phase. So that's more related with safety, which is something very important also in this real-time diagnosis tool. Also related with safety, it looks simple, but if you have to make a disconnection, an emergency disconnection, the BOP cannot try to cut the drill pipe in the tool joint, because that's, let's say, the harder part to cut. So you want to be sure that you're cutting the middle of the drill pipe. And that's just a way to visualize that in real time, but also consider the elongation of the column. So it's not just counting pipes and summing the lengths, but also considering the elongation because of its weight. So it looks very simple, but it's very, very useful to avoid problems that at the end of the day will be much bigger than just a disconnection. So in our experience, from 2014 to 2019, we monitor more than 108 problems. We found out more than 108 problems, mostly fluid loss and washouts. But Petrobras have a way to compute the savings in terms of rig days and the potential savings of avoiding these problems before they become bigger problems. And we have $130 million in almost 5 years. So that's impressive for us. It's a very good way to monitor the success of this project, and also to justify why we are moving from drilling and going to completions and productions, because that shows that has a lot of value monitoring this information and trying to take predictions and make predictions about the thing. So in completions, it's a new collaboration also with Petrobras. We are, let's say, updating the system to cloud and also for web interfaces. So you see that the curves and the schematics are a bit different. So it's a more modern tool. We are going to migrate all the system to this new technology. But in the completion operations, what you want to see? You want to see in real time where the equipments are, considering the column elongations. You want to check if you're not passing through a very dangerous zone. If you have some diameters that are smaller, you like to take care when passing the equipment through this part, so you can visualize this movement and measure also torque and drag and other things. In this case, we are also calculating the tank volume imbalance. So we calculate the volume of steel and material that's going into the well and how much of fluid is going out. So we can identify if you have some circulation loss or kick during the completion. But we also monitor if some valves should be opening or closing depending on the depth and the pressures. So that's something that we are monitoring now. But our intention is also to monitor other things in the future. So that schematic shows exactly, for example, the completion column approaching the point that reached the rest of the equipment that's already there to finalize the completion, and then if you should go slower now or things like that in a more visual way. And going to the production part, as I've mentioned, we have two fronts here. You have production in the standpoint of the production guys, which are more worried about the flow assurance problems and things like that. But you also have the point of view of the well integrity. So you put the well to produce, but you have to take care with the equipment which are there. So that module will take care both of things. And but what's the problem with that? When you are drilling or completing, you have a lot of information. You have a lot of sensors in the drill, in the beach, in the drill pipe, you have a lot of pressure, torque. You have plenty of information being sent to onshore, so you can analyze a lot of things based on that information. When you are producing, generally you have just pressure and temperature at the reservoir in the bottom part of the well. You have pressure and temperature in the Christmas tree, and you have pressure, temperatures, and some flow rates at the platform. So you have a lot of information. For example, here is pressure and temperature a long time, but you don't have a very rich information because you have just 2 or 3 variables. That's where our simulators come in. We use AlphaSim as, let's say, the simulator, the workhorse to generate more information. And then we use pressure, temperatures, and information that comes from the field as boundary conditions. So we can transform, let's say, pressures and temperatures in flow rates, in hold-ups, and amount of gas, amount of liquids, flow patterns, a lot of things that you can analyze later to identify a problem. So the use of simulation here, in my opinion, is almost mandatory because you cannot do a lot of data science or apply a lot of AI in a poor information, just like pressure and temperature. So we can create like a rich data set for this kind of algorithms. And so that's an example. So you have a well, it's installed, and AlphaSim is getting points from pressure and temperature and simulating the profiles of pressure and temperature. So these profiles of pressure and temperatures are being sent to stress algorithms and to calculate the well integrity and the equipment integrity in real time. So so far we are working more on that direction. So using the pressures profiles and temperature profiles to calculate the fatigue and stresses in the well equipment. But we with the same technology, we want also to tackle flow assurance problems. So that's where I come to the future work. We are working now, for example, with Repsol and Senai in Brazil, trying to improve the user experience instead of looking only to those curves, a lot of curves on the screen. Why can we have a better interface where you can interact and check how the well is being drilled in a better way? So we are researching VR techniques, 3D modeling of the process, and different dashboards that can pop up the best or the information that you need to pay attention more quickly. And for completions, we want to check workover operations, perforations, and things like that. And for production, we want to start to analyze flow assurance issues like slugs, paraffin, deposition, wax, hydrates in real time as well, combining our simulator with machine learning algorithms. So I reached the end of my presentation. I hope I still have some time. Just to mention that digital twins are becoming more and more important now, and we have been deploying this for a while and very successfully. We also have engineers that are, let's say, the new types of engineers that are working from the office, monitoring operations elsewhere. So that's a different competence that we have developed also in each class. And combining physical-based simulation with data science and artificial intelligence is something that we really are betting on, and we would like to collaborate more in these topics, especially for the flow assurance part. And that's it. Thank you for your audience.
Thank you, Vinicius. Very interesting presentation. I really enjoyed. I had a comment when you start the presentation saying that we have a lot of things in our industry that is model based. I mean by mathematical modeling, and nowadays most of the work is on AI, and it seems to forget these models that we have for years in our industry. So that's one of my questions. Is this for washout detection and for the case where is this based on mathematical models or in intelligence, artificial intelligence?
They are based on mathematical models. So, for example, the washout, the principles are comparing simulated data with real-time acquired data, and only the comparison of the curves. It's kind of for AI because you have what we call decision trees. So if this happens, if this, so it's the old way of doing these kind of things. Now you can put the AI to identify the pattern or the signature of the problem automatically. And this is something that we are, let's say, advancing now. But the way to identify the signature of the problem was, let's say, human knowledge with decision trees, and now you can apply the AI. But the fundamental part is you have a simulated data to compare with the real-time data. It's not just the data coming from the field that you analyze. That's why we think that we are never leave the simulation behind. What you are going to do is to couple both technologies and make what we call the hybrid models, because then you have a much more rich data sets to use in the AI algorithm.
So, for example, I have a question here from Bruno Levy about measuring the casing wear. I don't think that your system is measuring the casing wear, but can you compare this? Do you have any data on comparing this casing wear that you're estimating after running a log afterwards, after drilling the well, to compare if what you are estimating is the same or is near to what was predicted?
Yes, we are calculating in real time the wear, and for one, that's a very recent work, and we have one well that was drilled recently that was compared with the profile, and also compared with the other simulators that try to simulate wearing that Petrobras have, and the results were pretty much the same, both from what we simulated compared with the red in the field after using profiles, and also comparing the other simulators that they have. So it's very sensitive to some constants that you have to put from the interaction from the materials, depending on the fluid that you have. So you might find divergences based on these constants, but it's the pattern, where is it, and the magnitude is pretty good.
And related to and regarding the BOP to joint position, is there any sensor on the BOP that you need to install, or is mainly on the tally itself?
It's just using the correct tally, and we use information of the hook load and things like that to calculate the elongation. So, of course, when you build a project in PWDA, when you set the tally, you say the drill pipe and the material, the thickness, or the model. So we have the weight information to calculate.
Okay, and is this somewhere related to the emergency disconnection sequence that is set by the operator? For example, because we have this on the drilling program. For each operation, you have an EDS set on your BOP. Is this planning to be like an automatic decision for that, like linked to the EDS system, or not? It's just for information.
It's not connected there, but you have like a big in the real-time center. You have all those big screens, and one of the main dashboards that's always there is this information. So before making the connection, the internal procedure is just to check with the guy. Look, can I disconnect now, or I should move up or down a little bit, just to guarantee that that's in the front of the drill pipe. So it's more internal procedures.
Okay, Vinicius. So I think we run out of time, but thank you for the interesting presentation and for the Q&A session.
Thank you very much. Let me stop presenting.
So now we are going to our last presentation for today. Hi, Colin. Can you listen to me?
Yeah, I can hear you.
Okay. So Colin Daly is a PhD in geostatics at École des Mines de Paris before joining BP in 1991. He worked with Hochsar and Schlumberger since then. With Schlumberger, he initially managed the modeling offering for the Petrel software suite, but has since moved to an advisory role in the areas of geostatics and machine learning. He presents papers rather more often than he publishes, and had keynote presentations at Petroleum Geostatics, and we have one at the 2021 International Geostatics Conference. So please welcome Colin Daly to present uncertainty and spatial modeling, how machine learning helps change the landscape.
Thank you. Now I'm hopefully sharing my screen. Let me know when you can see it.
Yeah, I can see my big face on it.
Okay, cool. Right. Okay, so hopefully we're ready to go. The topic of the talk is uncertainty in spatial modeling and how machine learning changes the landscape. So really, I'm going to describe this more through an example than anything else. Initial reservoir model, and I've got one slide at the end showing it in a real case study. and then just a couple of slides on the theory right at the very end. So here's my synthetic model. You can see it on the left here. On the right-hand side, I've constructed a relative acoustic impedance also. Now, to make things a little bit more complex, I didn't create the RAI directly from this model. I introduced some noise on that and then created the RAI. So it's on a kind of a similar but not identical model, which helps me to kind of reduce the correlation somewhat. And we're going to look at either an 8-well case or a 36-well case. And I'm showing the configurations on the left where the 8 wells are and on the right where the 36 wells are. So the objective is, given a number of wells, given a number of secondary variables, we're going to try to estimate the one on the left. Okay, we're not going to use obviously all the detail from the synthetic reservoir model, just the wells and some seismic data and some simple parameters, and try to reproduce this synthetic model. Okay, so let's just give an overall view. What are we talking about? We're looking at a new algorithm that integrates geostatistical methods with machine learning, which I give the name EMBER. When I started thinking about this, the original idea was to have a very simple method, which would have no requirement to do a lot of the normal baggage you have with property modeling, like calculation of variograms and trends, etc., at least for the estimation phase. The idea really is it should help avoid the classic problem of stationarity, and I'll discuss that as we go along, what I mean by the stationarity and the problems that can arise. I would like it to be able to handle many input variables. Okay, classic geostats, you tend to have one secondary variable, but if we've got many things which might be good at helping to predict our target variable, let's say our target is porosity, can we use those? And will the result be more robust than the classical method? Also, I'd like the whole thing to be fast and to give us some useful results. So it turns out that immediately at the estimation phase, which is the first step, we already produce an estimate of local mean. We produce estimates of quantiles and estimates of sweet spots. And by a sweet spot, I mean an area where, for example, the porosity is above 20%. Okay, so we would like a probability of where porosity is going to be high. We'd like to get realistic models of uncertainty, and we would like our realizations to be better constrained than the classic case. So let's have a look at the construction process for this synthetic model, because it's useful to understand what's going on. So here we have flattened a section of that model, or at least of the construction process of that model. And we can see there's something like 12 zones. The little chunk in the middle here is actually a missing section. Okay, once we flatten the reservoir, then the fault that's in the middle has got a sort of missing section to that fault, and that's what that gap is here. Okay, so when the reservoir is put back together, there's no gap, obviously, it's just a fault. So we've got 12 zones, and here I'm looking at the facies that were involved. Now I use facies to yes?
Sorry to interrupt you. Just for those, we know that we are people that are facing some trouble with the video, but for those who are having that problem, just click in the engine icon at the bottom of the video screen and select original video. We are seeing your screen perfectly, Colin. It's just the audience that are having some problems. Please, you can continue. Thank you.
Hit the bottom of the screen, sorry. So I have to
not
escape
you,
from this
but
view.
It's not for you, it's the audience.
Yeah, no, but let me understand. What is it I've got to do exactly?
You can continue.
I can continue. Okay.
Thank you very much.
Okay, good. All right, so I'm looking at a flattened section here. As I said, the bit in the middle is the fault gap. Let me just put my pointer back on. Hopefully that wasn't the problem. So I've used some facies to construct this model, though I'm not going to use the facies in the final analysis. So we've got 12 zones. The bottom zone here is a very complex zone. You can see there's a lot of facies in here. And that's a carbonate, mixed siliciclastic carbonate zone. Above those, we've got a number of fluvially dominated zones, and the arrows are pointing at those. What's happening is, I think there's 5 of them, and between the different zones, we have varying net to gross. So this lower one here has got mostly shale. You can see grey is shale. There's a little sliver here of sand, but this is very low net to gross in this zone. Other zones have much higher net to gross. Another thing that changes actually is the orientation of the channels within them. You can see these kind of orangey things here are our channel bodies, and the orientation changes from one zone to the next. It's east-west or southwest-northeast or whatever, so it changes a little bit from one zone to the next, and net to gross changes. The others are the tidal shore face, and again, what's changing here is proximity. So in this base one here, the yellow means that we're sort of foreshore. As we move out here, you can see just a little bit of yellow, and then we move into mid-shore face, lower shore face, and the grey out here is shale, so it's marine shales. So that's kind of switching back and forth a little bit as well. That was the missing section, as I said. Here is the thing that we're going to try and estimate, which is a porosity variable. And we've added porosity on top of all of these things. So you can see the porosity is quite gradually changing in the shore face sands, but there's much more heterogeneity in the fluvial systems. Just having a look at a plan view of one of the layers here, this thick red line here is the location of our cross-section. And so we can see that in the 8-well case, there is not so much information nearby to the section. So I'm going to show a lot of pictures of the section. So you can see that it's kind of not very well controlled. Maybe there's some information just over here on the left. With 36 wells, we do have a lot more control. It's still not perfect. There's a big gap here on the south side, but it's a little bit better controlled. Okay, so what data have we got available for our model? As I said, we're going to have a number of wells, either 8 wells or 36 wells, depending on whether, which case we're looking at. But we've also got a number of variables which are available for modeling. And we've got 13 data variables. I'm showing 9 of them here. The first 5 are seismic attributes. The top left one here is the residual acoustic impedance, which, as I've said, is our best correlator to the porosity. It's not brilliant. It's a correlation of about 0.35 or something, but it is our best variable. We've got 6 geometric attributes. I'm showing 4 of them here. These 2 are depth attributes, and this one here is stratigraphic depth, so it's quite a useful variable. Obviously, porosity is likely to follow strata, but it may well be that porosity also depends on depth, okay? Particularly if you've had some diagenetic change, deeper values may be more compacted, may have had more diagenesis in there. So controlling also on TVD as well as stratigraphic depth is quite interesting. So we're going to control on both of these variables. We also have a variable here which just tells us which zone we're in. Are we in shore face or are we in fluvial zones? Okay, the other 2 things we have are embedded models. Now these are very different. An embedded model means that we're going to try and control on what kriging, and kriging is our embedded model in this case, what kriging might be able to add to the situation. So none of these variables, for example, tell us about correlation. None of the data variables tell us how good correlation is. So what we do is we embed 2 kriging models, one longer range, which is basically a hypothesis that there is some long-range correlation in the model, and another shorter range, which gives the hypothesis that there might be short range in there. Now, the machine learning algorithm we're going to use is able to distinguish which of these is best at prediction. So it sort of makes a prior assessment of the reservoir model and tells us whether long-range correlations are useful, whether short-range correlations are useful, whether the seismic attributes are useful, whether TVD is useful, and so on, and gives a relative contribution of each of those. And I'll show at the very end what I mean by is useful. Let me say it now. Essentially what it gives us is, at every location, it gives us a conditional distribution of the porosity based on all of these variables here. And then we're going to construct our final model using those conditional distributions. So here, again, just to get an impression of how good our variable is, here's the correlation between RAI and true porosity. Okay, and we can see that that correlation is relatively weak, but there's something there. It's about 0.35. Okay, so let's have a look at the final result, what our model is going to produce. So Ember gives us this kind of a simulation result when we got 8 wells. This is our truth over here. So you can see in the shore face sands, it's doing a remarkably good job. Okay, now basically this is using a very good estimate of of the variogram that I use for my simulation. And I'll discuss what happens when that gets a bit worse later on. But at the moment, I'm sort of saying that I've got perfect information in some sense. The uncertainty is telling me that I've got low uncertainty because pale means low uncertainty, dark means high uncertainty. So I've got low uncertainty in these shore face sands, but much higher uncertainty in the channel sands. Now that's fairly obvious actually, because the channel sands you can see in the true situation are much more variable than in than the shore face sands. And so our model is able to pick that up and understand that the uncertainty is lower in this region. So when we do our final simulations, our simulations are constrained to have a lot less variability in shore face sands than they are in channel sands. I won't spend time on this, but this just shows here that over here on the left, we're looking at the true correlation between RAI and seismic for the entire model. So this is for the true porosity. And on the right-hand side, we're showing the correlation for the simulation and the true porosity. Okay. Now, admittedly, we won't know these in the real world, but this just shows that actually we do reproduce very nicely the cross correlations that we'd expect. Okay, so let's zoom in a little and compare with classic geostatistical estimation. So we're zooming in just to the right of that fault. You can see the fault here. And here's my true model on the right-hand side. Again, of course, we don't know this in reality. And this is what we get if we do our Ember modeling versus a classic geostatistics Gaussian simulation. Now, the difference, right, is that the Gaussian simulation, we've done a separate model for each of the 12 zones. We've modeled trends, we've calculated variograms, subtracted variograms to transform to Gaussian and so on, each 12 times. With Ember, you don't. You have to just press the button once, okay? You make one choice, or well, actually, in this case, I'll make two choices of roughly what the texture of the variogram should be, what sort of correlation lengths I expect to see in channel sands, and what sort of correlation lengths I expect to see in shore face sands. And as I said, I'm using good information here for both the Gaussian and the Ember case. And we can see that Ember reproduces the coarsening upwards very, very nicely. It produces roughly the channel geometries very nicely. The Gaussian model isn't bad. It's perhaps not quite as good, but roughly speaking, you can see that it does reproduce the coarsening upwards fairly well. It's a lot noisier, but not so bad. Now, as I've said, I've used perfect information. That's to say, I calculated my variograms for the Gaussian case using the entire volume of my true data. Now, that's never available. And what happens if I do it just using the 8 wells, okay, which is a much more realistic situation? I'm going to show that in the next slide. And you can see what happens. The Gaussian model, using only the information available with 8 wells, has lost a very great extent. It's lost this nice coarsening upwards. And that essentially is the problem of stationarity. Essentially, we have made the assumption that each of these zones is stationary, and we've calculated variograms within each of the zones and so on. But in fact, they weren't actually stationary within there. It's just with 8 wells, the Gaussian models find it difficult to distinguish that. And what happens in a stationary model is that once you're away from well data, if you've got a hypothesis of stationarity, then the area of throwing in high and low permeability blobs can be more or less anywhere. Now, Ember, on the other hand, starts by constructing an envelope, a kind of the local conditional distribution everywhere, and must model using that distribution. And when it does so, the stationarity tends to be modeled much better. So even though we're now using pretty poor estimates of the local variability, you can see that we're actually preserving the coarsening up sequences very nicely here. Okay, a good way of seeing this better again is to look at our an estimation of a blind well. So again, look at our 8 well situation, and we've got circled here a 9th well, and we're going to try and predict that 9th well. And this here is the log at the 9th well. Okay, so this is the true situation, which we're going to pretend we don't know for now. Okay, so I'm not using this data. And I want to estimate this value here. Okay, and I'm looking at 2 layers. So the value at this layer here is to be seen here. It's in the channel system, and it's just below the highest porosity in that channel system, which would be the next layer above. This one here, we can see is in sort of mid-shore face, and you can see that over here. It's not quite at the top of the shore face sequence, but it's on its way up towards it. Okay. Ember is able to produce a number of things that I said at the beginning. It's able to produce, for example, a prediction of where porosity is above 20%, and that's what we're looking at here. Okay, so we're looking at that porosity. Here is a plan view. You can see the plan view is predicting porosity in this channel over here. It's not doing a great job on that side. I'll come back to that later. But this is our prediction of porosity. These are 5 Ember simulations, 1, 2, 3, 4, 5. And you can see that in all 5 of them, we're roughly speaking capturing the correct coarsening upward sequence in these kind of sands. In the upper channels here, in the channelized zones, we capture, roughly speaking, the features of channels, if not exactly where they are. So again, you can see up here, we're capturing the features of what channels look like, but not their exact locations. Now, one of the nice things Ember does, as I said, is it produces the full conditional distribution. That's what we're showing in this particular track here. So what we're looking at in red is the true porosity is red, and overlying it in grayscale, we're seeing the conditional distribution. So the darker it is, the more likely Ember is predicting that the porosity will lie in that area. So in these very dark areas here, Ember is saying there's a high probability that your true lag is going to lie in there. Your true porosity is going to lie in there. It then has a low porosity, and then it goes back dark again. Okay, so in other words, what Ember is saying is there's high probability, then low probability, then high probability. In other words, it's predicting a bimodal distribution at this location here. And that's exactly what we expect because it's a channelized system. You're either in the channel or you're out of the channel, right? And you can see that over here. I'm in channel, I'm out of channel, I'm in channel, I'm out of channel. And you can see that that's precisely what our simulations are giving, in channel, out of channel, and so on. And that's because our conditional distribution is making that prediction. You're in the channel, you're out of the channel. But you can see the uncertainty is relatively large up here. Here, or even better down here, you can see that the uncertainty is very low. So when I'm in the shore face sands, which were easy to predict, Ember is able to find that the uncertainty is very low. And that's why each realization looks broadly the same. Okay, let me look at one layer, layer 51. Here we're looking at the Ember simulation with 8 wells. And here we're looking at the simulation where I've got 36 wells. Now you can see with 8 wells, Ember is doing a reasonable job of picking out the channels. This is the truth up here. Is doing a good job of picking out this side, not so good at this side. But at 36 wells, it is picking out that channel belt on the other side here. This is the fluvial, and I'll explain later why this is happening. But the interesting thing here is what happens when I go down to using the short variogram. You can see that Ember up on the top here is still doing a good job at picking out both channel sands. What's changed is the texture inside the channel belts. So my channel belts are more or less discovered, but the texture is the part that the variogram is now controlling. On the other hand, with the Gaussian model, what I've got is much more variability. And again, that's that stationarity problem. Things are getting thrown all over the place. If I look at the blind well short variogram, on the left I've got Ember, and on the right I've got the Gaussian case. Now, basically, the part that doesn't change if I change my high frequency variogram is my prediction of the conditional distribution. That doesn't change at all. So you can see that Ember is not changing that particular thing. What is changing is the texture. So that slightly the simulations are a bit more noisy in the short variogram case. A bit more noisy up in the channels as well. But broadly speaking, they still have to follow the overall structure. In the Gaussian case, what's happening is, because I'm now at a very short range, we see that the uncertainty is just as high down in the shore face sands as it was up in the channel sands. So therefore, my simulation is just as kind of random as it is down below as it is up in the shore face sands. Let me just go back to the 51 case one more time very quickly. Here I'm showing some of the byproducts of Ember. which, as I said, Ember produces quantiles, a P10, P30, P90, P70. That's what we're looking at here. 10, 30, 70, 70 is here, 90 is here. And so what we're looking at here is the true situation and the RAI. Now, look at the RAI. If I've only got 8 wells, you can see that the RAI itself is only able to pick out the fluvial on the right-hand side. It doesn't do a good job at picking out the true channels on the left-hand side. And with only 8 wells, you can see that this channel here, or this well here, doesn't actually go into that channel sand here. So with 8 wells, it's extremely difficult to pick out that second channel. You can see maybe there's a hint of it up at the P90. So there's a small chance that Ember will pick it out, but not very high. And you can see likewise the probability here of having sand above 20%. Ember does a good job at picking out this channel here, but not such a great job at picking out this channel. In fact, it sees almost no chance of being above 20%, maybe a slight hint that's above 15%. At the 36 well case, you can see that now, even at the P30, certainly by the time I'm up at the P70, and this one over here is a P50, I'm able to pick out that sand on the other side. So having that extra well data gives me much better control. Also, it teaches me better about what the seismic is telling me. So I'm learning in 2 ways. And you can see that my probabilities of picking out these channels are much, much better as well. Okay, so I'm able to make up for the lack of information from seismic by having more well data. Looking at 36 wells with the short variogram, we can see that the Ember case is doing very well, okay? So the noise that we saw with the 8 wells is gone. I've managed to kind of identify things very, very well. The Gaussian case, even with 36 wells, is still not doing a great job. And that's simply because the uncertainty in the Gaussian case is dominated by proximity to well. Really, that's what the variogram tells me. So the uncertainty is still very high once I go away from well. And it doesn't matter whether I'm in the lower zones or the upper zones. Okay, one last thing I'm going to mention is basically I built my original model using based on this real field study, which is shown in the EAG, the upcoming EAG in 2020. And we can see that essentially I've got the same kind of results in a true well. Admittedly, the shore face is not quite as easy to predict as it was in the Ember model, but I wanted to show that Ember worked just as well. And we can see here that, you do get lower uncertainty in these shore face than you get in the upper shore face. And we've got a similar sort of thing. Ember simulations, in the lower shore face are easier to predict than they are in the fluvial sands up above. Okay. I don't want to go into the detail here because I'm running out of time, but what is different about Ember is that in the classic modeling, you build a model using all variables. The Ember one uses this notion of an embedded model and allows us to estimate conditional distributions using a relatively small distribution, simply using 11 variables. If I've got 10 secondary here, it's a relatively small dimensional problem. I'm masking, by this Markovian method, I'm masking the influence of these very, very many variables. So I don't need to use, or I'm able to kind of estimate my conditional distribution, my envelope, with a lot more accuracy in some sense. Now for simulation, it does turn out I need to use the full random function. So in the classic model, basically you're modeling the Earth itself as a random function. You model your trends deterministically, remove trends, and you treat the residues as a random function. You calculate variograms and then assume stationarity per zone. So basically what we've got is that the variogram and your hypothesis of stationarity determine everything. Now sadly, your residues might have a very high variability, 50, 60, 70%. So depending on what your hypothesis of stationarity is doing, your distribution of those residuals could be kind of pretty much anything. With Ember, you don't model the Earth directly as a random function. We make a direct estimate of our conditional distributions, which I've said before is a relatively small problem. It's 11-dimensional, so it's bigger than just estimating variograms and trends, but it is still a relatively small problem. And they don't have to be stationary. And already we get a bunch of things like quantiles and so on. So my first phase is, instead of just estimating a trend, I'm estimating a set of conditional distributions, and my simulation is now really just a question of sampling from those family of conditional distributions. So I do, of course, have some kind of notion of random function, but really all I have to do is assume my sampling function is a stationary random function. And that's a much smaller hypothesis than assuming that porosity itself is either stationary or can be reduced to stationary. Okay, so that's me done, I think. Thanks very much, and I'm ready to pass to any questions if there are any.
Thank you, Colin. Thank you for the interesting presentation. I don't think we have questions from the audience. I have one. Does amber is also good for carbonate reservoirs? Because you're showing a specific case with a channels in sand reservoir that is much difficult, rather than, like, for example, what we have here in Brazil, the big pre-salt reservoirs. But is this also applicable for this kind of environment that we have here?
Yeah, I think very much so, actually. In some sense, you could argue that it was almost developed. I had at least partly in mind the carbonate reservoir. So you can see at the, if I can go backwards, maybe I'll go backwards if I can. Right. I'll show you at the very beginning. I constructed a model using some kind of fascies, okay? But when I moved on to porosity, you can see that the porosity blends across those fascies. So the porosity is not actually hardwired to fascies, right? It's got some kind of concept that there's fascies there, but you can see it's much more smoothly varying. Now that's much more similar to what you're going to get in a carbonate reservoir, where, you know, the change from whackstone to packstone is not like it's not kind of strict. It's a much smoother variation, although there is some kind of control via fascies. Fascies has some meaning, but it's not really super strict. And you can see that where Ember was at its best, actually, was actually predicting in this zone here. You know, it actually predicted very nicely here because it didn't have any need for a strict knowledge of fascies. What it did, it was able to work out trends in a much more sophisticated way, let's say, than using, you know, the classic fascies model. So I think that it's because it's much better at finding trends and using trends than your classic model. I think actually it's particularly well suited for carbonate reservoirs where there aren't fascies per se, there are trends.
Okay,
also,
thank you.
I should say,
Colin.
I'd say one. If I have time, I'll say that there's one other thing that's quite useful. In carbonate reservoirs, you also have things like diagenesis taking place, which are relatively complex variables, and you can model them by certain hypotheses. You might say that my diagenesis is due to something like proximity to fault. Okay, I might say that there's been some water imbibition from the fault, or, you know, if I can roughly predict some kind of secondary process, and I've got some model of that, it doesn't strictly have to honor the wells, it just has to be a conceptual model. Now, Ember is particularly good. That's what it's good at doing, is taking a bunch of secondary variables like that and finding out their relationship to porosity, and then seeing whether that is a useful predictive variable in the final analysis. So as well as having a kind of a model of sedimentology, you can also have some kind of model of diagenesis and bring them both together, and then say, how do both of these together work to model your porosity? So I think, yeah, it's a step forward from what we've got in classic geostats model in terms of modeling carbonates. I think that's one of the things that's going to be very interesting to see when this is released later this year.
Colin, for the interesting presentation and for the Q&A questions session. I would like to thank for the organization, for the invitation for me to be here today, and for all the ones that are present today here, and for the others that were here from this 2 hours session. So thank you all. I'll pass the word for Diana to close the presentation. Okay.
Okay, Tiago, thank you. We are finishing here on the room 1, this 7th Galp Open Day. I kindly ask you if you want to continue to see us on room 4.